You can forgive a lot of things if growth is remaining resilient.
Expectations of higher growth are now so built into markets. The two-way risk on growth numbers are now really significant.
I really think that the focus, at least for the second half, is going to be on the slowdown in growth.
That's sort of a perfect scenario. We can have deceleration wage growth, economy stays reasonably firm, and the Fed has this clear runway to do what it wants.
As long as the economy is expanding, we're finding opportunities. I think don't overthink it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 this morning, negative by 0.6%. Kicking off June with a day of gains, but only just. We've talked about the calendar all week, many times. We need to talk about the calendar again. Following the weaker than expected manufacturing ISM in yesterday's session, we begin Tuesday, dialing into Wednesday and looking for this. The services ISM taking on so much more importance. We've been whipsawed by economic data. Berro will be whipsawed all over again.
The disappointments have been coming in pretty consistently when it comes to U.S. economic data, and it is giving fuel to the people who believe that this economy is decelerating at a faster clip than many people, including the Federal Reserve, is really recognizing. This is narrative ping pong. It can shift really quickly, but you get enough of these types of prints, especially with the services ISM, and suddenly you have a trend.
A phrase you'll hear a lot this morning is bad news, and we need to define what bad news actually is before we start talking about whether the bad news is bad news. You know where I'm going with this. So let's talk about some numbers. Payrolls on Friday, the estimate in our survey just nudging a little bit lower to about 185. These are some numbers for you. Bank of America below 125, bad news could become bad news. Stuart Kaiser City just yesterday, headline payrolls below 150 would be worrisome. How worrisome would sub 150 be this Friday?
Well, it sort of depends on who you ask. You mentioned Bank of America. They say Goldilocks range for equities is between 125,000 and 175,000. You have Stuart Kaiser saying sub 250,000 is negative. You have Citigroup's Andrew Hollenhorst talking about a rapidly weakening economy with payrolls coming in at 140,000. We don't know even how to interpret the data that we're looking at because we don't understand the dynamics behind them, which is the reason why the ranges that you are seeing are ever growing, which is the reason why, as Bank of America came out this morning and said, fragility in stocks is near a 30-year high. People are trying to understand what their paradigm is as stocks whipsaw on a single name basis, unlike what we've seen for decades.
It was only 2 weeks ago we had this breakout in the PMI. Remember that? And the economy was too hot. And now we're having this downside surprise on the SM. And maybe things are too cold. Neil Dutta of Renmax saying this yesterday. You picked up on the same thing. An accident could be brewing.
Basically, he's saying that right now the economy is probably weakening more than the Fed is going to recognize it because inflation isn't coming down as quickly, at least in the headline data, as it will be later on. So he thinks the Fed's only going to cut once or not at all, which would be an accident. He thinks that the Fed should cut more because, honestly, to support this economy, you need some more strength. This is the debate right now. We don't understand even where the range of risks are. Is the Fed at a greater risk of allowing inflation to run too hot into next year, as we've heard from a number of people, or at deflating and, frankly, tanking an economy that's losing steam really rapidly? We don't understand. And if we listen to the executives, CEOs, not clear they understand either because they're saying that high-income consumers are doing just fine. Everybody else, I don't know, it's kind of a crapshoot.
The story could change day to day. And it could change again a little bit later when we get more economic data with jolts just around the corner. Crude is lower for 5 consecutive sessions. Maybe that is speaking to the fear of an economic slowdown. Check out the scores right now across the board. Crude at the moment, Brent crude, a break of 80 in yesterday's session for the first time since February. We are looking at lows we haven't seen since January on WTI. We're down another 2 percentage points. WTI 72.58. Looking at crude and looking at the bond market, yields have been lower as well. 438.84, we're just about unchanged on the session. Equity futures pulling lower by 0.55%. Coming up this hour, we'll catch up with Julian, Emanuel of EVERCORE. As bets grow, the Fed will have room to cut this year. Former Fed economist Claudia Sahm on why inflation feels so bad. And Bloomberg's Will Kennedy as Brent crude breaks below 80. We begin with our top story. Weaker than expected manufacturing data, leaving the door open for rate cuts. Julian Emanuel of EVERCORE writing this. Volatility is going to rise from these depressed levels, given the catalysts of payrolls, CPI, the Fed, and the extraordinary machinations of US politics. Julian's around the table with us in New York. Julian, good morning to you.
Good morning.
How much weight do you put on that data out yesterday?
Well, we have to step back and recognize that, in particular, the last couple of weeks have been really quite extraordinary. So a week and a half ago or so, the Bloomberg Financial Conditions Index printed the loosest it has printed since 1994. Then you had basically the number 3 weight in the S&P 500 over this last week and a half, up 20%. Yields down 20 basis points. You would have told me 2 or 3 weeks ago, if you had the combination of all of those things, the S&P 500 would have been up, what, 2, 3, 4%? We're down. And that points to the fact that the market is now looking at the data differently in an environment where we still have inflation uncomfortably sticky towards that 2.8 on the core PCE.
I've got a friend for you. It's called Marco. He might agree with you. Marco Kalanovic over at JP Morgan said this: a number of macro signals are pointing to economic slowdown or a recession. Market risk sentiment remains positive. Stock markets are close to all-time highs. Basically implies something has to give. Does something have to give here?
We think so. We don't think it is the end of this 2-year bull market, okay? But again, you go back to this idea that even in a non-recession year, the average peak-to-trough drawdown is 13%. And I think based on the events that we've witnessed, let's say, in the last week alone, both geopolitically, politically, economically, and otherwise, one can argue that this is at least an average year.
Which raises this question of what does a drawdown look like? Yesterday, we tried to get one. Initially, the ISM data came out, and it was bad news is bad news. Stocks sold off in tandem with bonds actually getting a bid. And then suddenly, people were thinking, maybe this is a dip. OK, we're going to buy. And that's essentially the action that you saw at the end of the day. What's to say that's going to really materially change?
Well, the speculative juices over the last several weeks are certainly there. No question about that. And the tendency tends to be is that those types of episodes ebb when the P&L starts deteriorating. So if everyone's favorite meme stock starts heading back towards $20 or lower, and everyone's favorite stock, which is about to split on June the 10th, starts to trade sideways or lower. And interestingly, this idea of stock splits being, outright bullish for a stock is very specious. And to us, it has echoes of something that happened in late 2020 when you had 2 of the other Mag 7 stocks split on the same day. And that really actually was an interim top in the NASDAQ.
Okay, let's give some names to what you're talking about. You're talking about GameStop and NVIDIA, right? You're talking about GameStop, the mean stock that just can't quit roaring kitty. Good morning. And then you have this question of NVIDIA and the stock split and how beneficial that'll actually be. Let's start with GameStop. Is there actually any message for the broader market in the rally that we've seen there, in some of the roaring kitty type of activity, or is this just an idiosyncratic story that's gotten legs once more because people find it appealing?
Well, to be truthful, the message is the Fed really needs to think very long and hard about cutting rates when you have this degree of speculation still in the markets, buoyed by the liquidity that, as we saw a week and a half ago, had gotten to all-time lows going back to 1994. There needs to be a recognition that the dynamic is perhaps a little bit more finely balanced than this rally would otherwise indicate.
Do you see a parallel between GameStop and some of the speculative activity and NVIDIA and some of the really elevated valuations and this feeling that it's headed to anywhere? It could double, it could triple, it could become a $20 trillion stock in the next, 2 years. I mean, people's expectations are going to the moon. Is that because of where rates are? Is that because of expectations of a Fed rate cut or just a paradigm shift in a technological advancement?
No, you do have to differentiate. We've been on this program a lot in the last year. We're early to the AI revolution. We are firm believers in the AI revolution. But again, if you go back and you think about the internet in the late 90s and the early 00s, what you had was a paradigm where those types of developments and the good feeling around those share price gains extended the economic cycle, but didn't eliminate the economic cycle.
Where do you think we are? Mid-90s? Late 90s? Where do you think we are?
I would say you're really in the late 90s, because when you think about there's a desire to say, well, this is 1995. This is the dawn of the entirety of it.
Why are they wrong?
Well, they're wrong. Well, first, I'll say why they're right. Okay, and why they're right is because you're actually in the early innings of AI adoption, and it will be a game changer, and it will be a productivity enhancer. Will it be a productivity enhancer to the degree that the internet was? That remains very much an open book. You hear Chair Powell sort of poo-poo that idea in the short term. They're wrong because when you think about 1995, the only time the Fed cut rates because it could, not because it had to. The difference was that, yes, the economy was strong like it is now, but core PCE was already at 2.1%. We have a different paradigm, and multiples were 14 times versus 21.5, 22 times.
So it's late 90s. Is the juice worth the squeeze, or is it time to step away?
Well, as an active manager, you know, you need to be invested on the one hand, okay, but the fact is that the market dynamics and the market structure actually afford the ability to hedge really almost like never before, because 5.25% interest rates work, A, because cash is attractive, but B, because selling call options against buying very cheap put options is about as attractive as it gets.
Are you basically saying that as an equity strategist for decades, you like bonds and cash?
Look, bonds is you have to differentiate between bonds and cash here, okay? And I think part of the error of the last year or so was this expectation that cash would become worth less. And what we're finding is that because inflation has remained stickier, cash has retained its value. Bonds are going to be what will work if there is, a downturn. And I think that's part of the message of these last couple of weeks, is that there may not be a downturn, but there could possibly be sort of this growth scare dynamic.
So in other words, are you saying initially cash looked good, but you're moving out the curve because you do see some sort of deceleration?
Very gently. Very gently. Our view is that at EVERCORE ISI, we do expect a slowdown at the end of this year into early next, and that's certainly going to be bond bullish, and it's certainly going to be part of the dynamic that causes the Fed to cut rates. But you really have only started to see these beginning signs of a slowdown, and what you're going to need to see is that inflation to fall in tandem with an accelerating slowdown, if that's the case.
I feel like over the last 10 minutes we've bullied you into sounding more bearish than you actually are.
Well, look, to be clear, we have felt uncomfortable with valuations where they are.
Yeah.
Okay. When you look at the long history of returns, the average return at this valuation on a year look forward is 0. Now, you've also had times like late 20 and into 2021, and obviously, since you asked the question, 99 and into 00, where that has been wrong. You look, those peaks were 28 times earnings. That's 6,300 on the S&P 500 right now. What we're saying is that it's time to catch our breath, given all the uncertainty of these dynamics, particularly given the fact that the price of uncertainty, volatility, is so incredibly cheap right now.
Julian, it's good to see you. Thank you, sir.
Thank
Julian
you.
Emanuel of EVERCORE, kicking off trading with us this morning. Equity futures negative by 0.6%. With an update on stories elsewhere, here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. The rupee fell and Indian stocks dropped the most in 4 years as early election results indicate the race there is much closer than any of the exit polls estimated. Narendra Modi and his BJP party are seeking a third term in power, but initial tallies signal the party is struggling to win a majority of seats in national elections. Airbus may be closing in on a deal with China. Bloomberg News has learned the plane maker is negotiating a major sale of more than 100 aircraft to China. Talks have gained momentum since President Xi Jinping visited his French counterpart Emmanuel Macron last month. And a glitch in a software update is being blamed for trading halts at the New York Stock Exchange yesterday. The glitch also led the NYSE to incorrectly display 99% drops in companies including Warren Buffett's Berkshire Hathaway. The disruption was resolved after 45 minutes when the exchange reverted to running a different software. The NYSE will cancel the bad trades in Berkshire and is reviewing other erroneous halts. That's your Bloomberg Brief. John?
What a mess. Yahara, thank you. More from Yahara in about 30 minutes' time. Equities a little bit lower this morning. We're down by 0.6%. A massive week of data. Coming up next, the weight of inflation.
We've got a lot more work to do on the price side. Prices are still too high, and we have an aggressive cost-cutting agenda that we're going to continue to push.
That conversation just around the corner, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt. That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Live from New York City, welcome to the program. Equity futures near session lows. We're down by 0.5%. Yields pulling back too. We're down a basis point, 437.67. Much more on crude. 5-day losing streak. More on crude a little bit later. WTI 72.56. We're down by 2.2%. Under surveillance this morning, the weight of inflation.
We've got a lot more work to do on the price side. Prices are still too high, and we have an aggressive cost-cutting agenda that we're going to continue to push. Inflation down 60% off of its peak. That translates into real earnings, feeds back into consumer spending. And, let's take a close shave with Occam's razor, if we will, and just kind of call that a healthy, kind of perpetual motion economy that's been reliably delivering for working households for a while now.
So here's the latest. Despite cooling inflation data, rising prices are making Americans critical of the economy. According to a Gallup poll last month, 41% of Americans name inflation or the high cost of living as their top issue. The cost of owning or renting a home ranks second at 14%. Claudia Sahm of New Century Advisors writes, the people who experience the U.S. economy continue to disagree with the people who measure it. And the most likely reason is inflation. Most Americans still see it as a major problem, while most economists do not. Claudia joins us now for more. Claudia, let's get into this. It's a fantastic piece. Help us understand. Are we measuring it wrong? Is it just a difference of perspective?
It's more about the perspective. Inflation is just a change in prices. Right? It is completely legitimate for most Americans to compare back to 2021 before prices took off. And it's completely legitimate for economists to look at, hey, what's happened over the last 12 months? Right? So it's all the same thing. We're just using a different perspective. And unfortunately, we end up talking past each other. And this is not about semantics. Right? There's a real problem or a real disconnect here.
Claudia, which perspective do you think is more important to policymakers?
Well, policymakers serve the American people, right? So they need to look on all fronts. And again, it absolutely makes sense why people use the overall increase in prices as their reference point. And it's really important that we understand that the prices are not increasing at the same pace. So again, policymakers serve the people. They do not serve economists. And so they need to focus on that. And yet all these pieces go together. There is not tension between the definitions.
So, Claudia, what's the policy shift that comes from the recognition that people's feelings aren't wrong and the way that they're looking at it isn't wrong? And if policymakers serve the people, well, how should that shift what policies they follow?
Right. So policymakers need to move past the idea that this is all about the economics. Right? There are perceptions here that are very important. A big part of the piece, once I move past what the definition of inflation is that you have a big disconnect between how people view their own finances. There was a recent survey that said about 70% of people view their own finances at least good, comfortable. And yet when you ask them about the national economy, the same people, about 25% say the economy's good. Right. So this does not make sense. In it doesn't make sense in tying it back to economic conditions, because those people, they're representative, they ought to all add up and tell us about the national economy. And that's the thing. It's a real puzzle. This is what policymakers, particularly at the White House, maybe less at the Fed, need to understand. And they got to stop talking to economists about this. This is out of our lane.
Yeah, I guess that the question is, as John said, is this a messaging exercise? Yes, it's not totally rhetorical. At the same time, is this a matter of saying to people, look, inflation is still a real problem, which is the reason why we're holding rates where they are? Or is it different? Is it saying that, for example, we can cut rates on the margins to help these people, or maybe move houses more aggressively on the market, and then take a look at where inflation is in a year? I mean, how does this change from a messaging standpoint, if not from a policy standpoint?
I don't think it's messaging, right? There is something going on that make people pretty okay with their finances. Their finances depend on, what are the interest rates? Have they bought a home? Can they buy their groceries? I mean, if you ask them, they're like, we're doing okay. I mean, not everybody says they're doing great, but I mean, these are the things that economists or the Federal Reserve, they want to get out there in the economy, slow inflation down. They use interest rates. How does that affect people? But if you ask them how that is affecting them, it's like, okay, we're doing it. But if you ask them how things are going, big picture in the economy, it's bad, right? So again, there is a disconnect that, they need to figure out what is going on. And it's not entirely, it's part of it. Part of why people are a little downbeat has to do with inflation, but there's something more. And that's what... Not the Fed. Again, I don't think the Fed needs to worry about the messaging. They're going to do what they do. But there's a lot of other policymakers who are out there in front of people, and they can't act like, well, cutting prices or getting interest rates down is going to fix that. Well, it might help some people, but it's not going to fix that disconnect.
We'd love your view on Fed policy while you're with us, Claudia. I'd love your view on this. Lisa mentioned Neil Dutta of Renmac. This is what he's got to say at the moment. He says there is a potential accident brewing. He has some conviction that core inflation is slowing, but hawkish rhetoric will look offside relative to the incoming data. Do you think there is a bit of an accident brewing at the Federal Reserve?
I'm extremely frustrated that when the Fed talks about the risk to the economy, that they're hyper-focused on inflation could take off. We might have to hike. I think, and I agree with Neil in the sense that we should be talking about the other risk. Employment could really weaken, and then we're having a Fed that's not cutting 25 at a meeting, they're cutting 75, right? And we are not talking about that risk. It's not my baseline. But I think we ought to put all the possibilities on the table and really think about them and prepare markets, prepare people for, hey, there might be something else in the card other than hiking. And it's just not in the conversation, which is mind-blowing among Fed officials.
One of the reasons why is it's just been so difficult to get the economy right and to understand the trajectory that we're looking at. Just to sort of give us a sense of where you think policy has had an effect, do you think that higher rates have actually kept home prices high by reducing the volume of sales?
The Federal Reserve, through the unconventional monetary policy, so the buying of the mortgage-backed security, they have completely what's the right word, have affected the housing markets in a way that have been unusual and, frankly, detrimental, right? Because rates moved up so fast. Yeah, I'm trying to come up with the right word. And so I think it's really hard to look at the housing markets and give a diagnosis of what the Fed did, because you have to put the whole picture together when they were pushing down house prices and now they're going up. And I think they're just trying to, they've got a mess they're trying to unwind. And yet that is one of the interest rate sensitive sectors. And one could argue that this unusual setup is why the transmission, so their higher rates, haven't quite pulled into the rest of the economy.
Interesting. Claudia, well handled. As always, Claudia Sahm, it's good to hear from you. Thank you. Equities right now on the S&P down by 0.5%. Crude, 5-day losing streak. Brent crude breaking below 80. We'll catch up with Bloomberg's Will Kennedy on the other side. Live from New York, this is Bloomberg. It was quite the reversal in yesterday's session. We were down and down hard after the ISM, and then we recovered and finished in positive territory this morning. We're down again. by 0.5% on the S&P. On the Nasdaq, we're off by 0.5%. This time yesterday, the Russell was up more than 1 full percentage point, and now it's down 1 full percentage point. We are all over the place and whipsawed from data point to data point. Switch up the board and get to the bond market. 2-year, 10-year, 30-year. The 2-year, 479.95. It was only a few weeks ago, May 23rd, when we had a stronger than expected PMI and we were all talking about the economy running too hot. That morning, the 2-year opened up at about 487-ish. We've pulled back down to about 479.95. Just data point to data point. And Lisa, I know we've both read the same note. Kit Jukes, SocGen. It takes more than one soft ISM manufacturing print to signal a change in the economic outlook. But if it only takes 2 swallows to signal the arrival of summer, then ISM services data are important. We talked about starting Tuesday, dialing into Wednesday. That data point has taken on a lot more weight in the last 24 hours.
We're looking for narratives. We're sort of searching for what to sort of hook into in terms of a trajectory going forward for the economy. If the ISM print that we saw yesterday in manufacturing was a read-through to Wednesday and what we get tomorrow, then all of a sudden people are going to talk about a more rapidly deteriorating U.S. economy, slowing to maybe slow, not necessarily just slowing, but not slow.
What we talked about repeatedly yesterday at the end of this program. Let's switch at the board and get to crude. 5-day losing streak on WTI. This is what it looks like right now. Brent crude's at 76.87. WTI is down another 2.2% at 72.57. There was a big supply side story in the mix to start yesterday. But once you get a data point like the one we got mid-morning in America, people start to talk about the demand side of the equation a little bit more. Are we talking about supply here, or are we talking about demand?
Well, we never really know with this. On one hand, you've got the supply story with OPEC Plus agreeing to bring back online certain barrels later in the year, starting in October. That was a potentially dovish signal to the oil market. But then there have been numbers of people talking about peak gasoline prices, the fact that even with some of the incredible increase in driving season, et cetera, the demand for oil and gas just isn't there. So to your point, hard to gauge out what exactly this is. Nonetheless, a lot of people are talking about potentially more negative price pressure on the margins for now, at the moment, until the next narrative comes into play.
The lowest level since January. Brent crude right now, 76.88. Under surveillance this morning, weaker than expected factory data sparking a rally in treasuries. ISM manufacturing falling to the lowest level in 3 months. We'll get factory orders, durable goods and JOLTS job openings all due at about 10 a.m. Eastern time. It was the economic data yesterday that got this market really started this week. ISM was the weakest in 3 months, sub 50 in contraction. New orders, the biggest drop since June 2022. Will that be confirmed by services just tomorrow?
Michael Darda over at Roth MKM quantified it in terms of what the read-through from that new order statistic that you talk about is to the S&P 500. He said that it's the levels there are consistent with declines in both the S&P 500 earning estimates and capital spending growth. So just putting out there that price to perfection is probably an accurate way to characterize where the market is based on what ISM manufacturing numbers are telling you. Again, is this a quirk in the data? We've seen it in other peripheral data. The S&P Global manufacturing data comes to mind in particular.
Here's another economic data point. This story right here. President Biden cracking down on immigration. Bloomberg reporting he'll sign an executive order looking to prevent new asylum claims by migrants who walk across the US-Mexico border. The move would stop claims at the border if crossings hit 2,500 a day. I call this an economic data point. We'll catch up with Steve Englander of Standard Chartered a little bit later, who will point to this issue as a big issue in the labour market. Is this going to be a big data point going into payrolls, not this Friday, but in a few months from now, a few quarters from now, maybe even a year from now?
Tony Capuano of Marriott yesterday saying immigration has actually been really important for them in order to get enough people to staff their properties. He was talking about how he's looking for more permits to actually bring more people in. We have asked people repeatedly this, and to some degree, it feels like it's sort of colored by a certain politicization that has had people disagree on just basic fundamental economics. You have had a number of Wall Street houses come out and say the immigration that we have seen has kept down wages and has increased growth pretty dramatically. Unclear how quickly that could reverse and how much exactly we've gotten a boost from that.
We'll put some numbers on that a little bit later this morning. Look out for that conversation. Elsewhere in the commodity market, crude prices falling below $80 a barrel. It's the lowest level in nearly 4 months. An OPEC Plus decision to bring more oil to market despite an extension of some production cuts is raising supply concerns. We can catch up with Will Kennedy now in London. Well, let's go straight to it. I asked Lisa this question. Help us out. Is this a supply side story, or are we starting to worry about demand?
As always, I'm going to be boring and say that it's both. Clearly, what traders are confronted with right now, though, is a situation where they're starting to see the prospect of those OPEC cuts, which have underpinned the market in recent months, being unwound against a period where the demand outlook may, as you're alluding to in your economic commentary, be getting more uncertain. It's worth pointing out that thus far, since the end of the pandemic, demand has been strong and tended by historical standards to be strong, adding 2 million barrels a day last year, which is very healthy, and by historical standards strong again this year and ahead of expectations. So that may well continue, but I do think that the decision that OPEC made at the weekend probably makes the market more vulnerable to any wobbliness in demand.
Well, can we talk about the decision over the weekend? A bit of confusion around it. On the one hand, they're extending. On the other hand, they could boost supply a little bit later this year. Where should the emphasis be?
I think the emphasis should be on the fact that it was a deal that enabled OPEC to continue presenting a united front until the end of next year and deal with some slightly tricky issues. The most important issue that they managed to deal with was the production level for the UAE. The UAE has always felt that it was having to do more heavy lifting within the current quota setup and had been campaigning for a higher quota. Part of the agreement delivered that. They're going to get 300,000 barrels a day extra next year, which no one else is going to get to. But to make sure that that was not taken too badly by the market, they promised to restrain the broader production target until 2025. So it is a mixed picture. It takes some understanding, but I think it was a deal that enabled them to deal with some tricky issues and preserve the unity of the group going into next year. And I think the bullish argument is that we have a much clearer idea about what policy is going to be until the very end of 2025.
Well, just to go to the demand side of things, do we have any sense? I mean, travel season is alive and well. A lot of people are on the roads, traffic jams galore. Congratulations. But there is this feeling that it's not that people are driving less. It's not that people are flying less. It's just that maybe they're using less fuel, or that's the reason why demand isn't as great. I mean, what's your sense? Is it because of some sort of economic downturn, or is it just because of greater efficiency, or is it just because of U.S. production that's offsetting any incremental gains in demand?
I think the broader picture is that despite some signals around the edges that things may be getting a bit softer, that underlying demand remains strong. I was looking at someone pointed out to me this morning a chart from the oil trader Vitol that's saying jet fuel demand around the world is now for the first time truly above pre-pandemic levels. We still think people are driving a lot. In fact, gasoline demand globally looks strong. There's a bit of weakness here and there in diesel demand, which is more leveraged to industrial parts of the economy. But overall, I don't think there's a compelling reason to say demand is weak. Clearly, if people are getting concerned about a slowdown in some parts of the economy, it may not be quite as strong as previously thought. But I don't think it would be fair to present a demand weakness narrative just yet.
I guess then, given that there really isn't necessarily weakness materializing, and given the fact that on the supply side, things can change really quickly, how do you understand the story, for example, from Maersk, AP Maersk, the shipping company that came out yesterday, increasing its profit forecast for the second time in barely over a month as they look at some of the disruptions that they're seeing and just the fact that they're going to be able to continue charging a significantly higher rate to ship goods? Does that kind of disruption give people pause? Are people still talking about the potential for this to percolate over into the oil sector, oil tankers getting disrupted, or have people basically become benumbed to some of the possibilities that haven't come to pass?
I'd make 2 points on that, Lisa. First, that the world economy has adjusted, that shipping oil around the world has adjusted to the problems in the Suez Canal, and oil's getting to where it needs to go. But it has had a material impact on the oil market because ships having to sail these longer routes, and that's good for Maersk's profits, but it's also been very good for oil demand. By some estimates, it's probably added several 100,000 barrels a day of extra global oil demand just because those ships are having to go that much further around Africa to get from Asia to Europe. So it is another reason why the demand picture is still pretty healthy.
Well, let's just finish on the demand picture more broadly in the commodity complex. Are you seeing any confirmation of concern beyond crude in places like copper, iron ore?
I mean, the copper has obviously been a bullish story over recent months. I think there's a debate within the metals trading community about how much of that is based on fundamentals in the here and now, which don't necessarily look super strong. compared with the flow of investor money that's come into copper because this narrative has been developed about the medium-term outlook around electrification, around batteries, around EVs, and a lack of supply. So there may be a short-term, medium-term mismatch there. But I don't think we're at a stage where people are looking around the commodity complex thinking the global economy is about to get a chill. Now, that may come, but that's not what we're seeing right now, I'd say.
Will Kennedy, thank you, sir. From Bloomberg out of London on the latest in the commodity market, both in crude and in copper at the end there. Copper at the moment, a break of 10k. We're down about 1.5% in London trading. Let's get an update on stories elsewhere. Here is your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Brexit architect Nigel Farage is running in the UK's general election next month. Farage's announcement comes less than 2 weeks after he said he would not run because his time would be better spent helping Donald Trump get back into the White House. Farage has stood to be an MP unsuccessfully 7 times, but is currently more of a household name than some conservative ministers. Maersk said the world's supply lines are more impacted than first expected from ongoing disruptions in the Red Sea. The global shipping company raised its profit outlook as disruptions remove capacity from the global fleet and provide a boost to freight rates. It's the second time in about a month Maersk has boosted its outlook, with the stock rising 22% in the month of May. And E-Trade is considering banning meme stock leader Keith Gill, known as Roaring Kitty, from its platform. The Wall Street Journal reporting E-Trade and parent company Morgan Stanley are concerned about potential stock manipulation around his recent purchases of GameStop options. Gill bought a large volume of the video game retailer's options through E-Trade last month, reigniting a meme stock frenzy. Then, this past weekend, he did it again, posting a screenshot of what appeared to be a $116 million position in GameStop, sending the stock up 31% yesterday. That's your Bloomberg brief. John?
Yahara, thank you. We'll see Yahara again in about 30 minutes' time. Let's save the conspiracy theories just for a moment. Let's go to that Wall Street Journal piece. According to people familiar with their internal discussions, we talked about one concern that E-Trade has. There's two. The debate includes whether his actions amounted to manipulation, one, and whether or not the firm is willing to risk drawing the attention of his meme army by removing him. Two, the second point's far more interesting, isn't it?
Especially based on what happened to Robinhood when they tried to take him off their site. I mean, there's actually a precedent for this, and if they do have that army withdraw from E-Trade, well, how big is that army? I mean, clearly he has quite the following who are pretty avid red band supporters.
And never mind the legal concerns, just sort of the concerns that they come after the platform. Talk more about that a little bit later. Up next on the programme, the case for a July cut.
What we think we're going to see is softer inflation and softer activity in labor markets. If you put both of those together, that's going to be a pretty powerful sign to the Fed that it's time to start cutting rates.
Really interesting conversation with Steve Englander and Standard Chartered coming right up. Live from New York, welcome to the program. Equity futures negative here by 0.5% on the S&P 500. Rally in the bond market yesterday. Yields lower, down again by almost a basis point on a 10-year, 4.38. Under surveillance this morning, the case for a July cut.
It really comes down to the data. We can spend all of our time listening to the Fed speak, and that's important, and it gives us some guidance about where they want to go. But where they will go will depend on the data. And so what we think we're going to see is softer inflation and softer activity in labor markets. If you put both of those together, that's going to be a pretty powerful sign to the Fed that it's time to start cutting rates.
So here's the latest. Treasury yields slipping to their lowest levels in more than a week after weaker than expected factory data in the US. Investors now looking ahead to a busy slate of jobs data with jolts at 10 a.m. ahead of the payrolls print on Friday. Steve Englander of Standard Chartered writing this. A July cut is our baseline. There are 2 more PCE releases before the July meeting, so there is considerable room for core PCE to slow. Steve is with us right now. Steve, good to see you, buddy. I saw it in my inbox yesterday before the ISM data came out and not afterwards. You didn't think this market was placing a big enough probability on the prospect of a July rate cut. Talk us through the call.
Well, first, the market probability is like 10 or 15% right now, just a couple of basis points priced in. So the very almost de minimis in terms of rate cut probabilities. What we have seen is some deceleration in the numbers in terms of PCE inflation. One of the things that we've looked at is if you look at the February 2024, March 2024, April 2024, they're all below their corresponding months in 2023. So, at the beginning of the year, there was a seasonality argument that maybe price increases are bunched at the beginning of the year. That possibility still rises. The other part that's there, and that's something Andrew was alluding to, you take a look at GDP now, like 3 weeks ago was over 4%. 10 days ago was like 3.5%. Now it's 1.8. The numbers have shown a trend towards softening. And, the Fed has been kind of mixed in terms of saying what constitutes a real slowdown that would get everybody on board for a cut. But they've been unanimous almost in terms of saying that if we begin to see the economy slowing down, that's enough. I mean, because they really, really believe in the Phillips curve, and they would think that that's the Phillips curve manifesting itself.
Steve, you pointed to 2 inflation reports between now and July as a reason that the door was still open, the window was still open for a cut. You didn't talk about payrolls just then. Can we talk about that? You mentioned Andrew Honhorst over at Citi. His call on Friday is 140. And he thinks once you start to get prints like that, that opens the door for the Fed to make a move in July as well. What's your number for Friday, and how does it inform the ultimate call?
I mean, we're at 195, but keep in mind that we see a lot of immigration in this number. And, we reported that, based on data that we have on employment authorizations that are being handed out, that, over the last 6 months, maybe 110,000 per month of NFP are people who cross the border kind of, called undocumented, applying for asylum after a period of time. They get work permits and they can work for Bloomberg, they can work for Standard Chartered, and they can get counted in NFP just like anybody else.
Given that, Steve, can you give us a sense of why this is making it difficult for the Fed to understand the real economy? In other words, what kind of distortion does this create for people who are trying to understand the direction of the economic data points?
I think if you listen through sort of a week's worth of Bloomberg surveillance, 90% of the conversation will be on demand, in terms of macro impact. In terms of being able to understand supply shocks, what their magnitude is, what their impact is, the market and the Fed have a lot of trouble because typically those are unusual. It's not the same as saying, okay, last year we had 1% fiscal thrust. This year we're having 0.5% fiscal thrust. Figure out the impact. It's usually very hard to assess what the impact is. And as we discovered until we were able to get the data on authorizations, it's hard to get any kind of numbers on the magnitude of the supply shock.
So are you basically saying that the immigration supply shock, which essentially has created these pretty robust labor market numbers, has masked an underlying weakness that you think the Fed needs to address as soon as next month, and that they may have to address it repeatedly this year with further rate cuts at a time when the data may look good but will quickly deteriorate, especially if immigration stalls? Is that basically the scenario that you're laying out?
Roughly. We think the economy's slowing down. We think that the data are suggesting that. You take a look at some of the data on consumer finances, you take a look at where most of the surveys are on employment are a little bit downbeat, especially the surveys that would capture traditional workers, not kind of new immigrants. And we do see this downward slow, but it's downward progress in inflation. It does leave them room to cut. July, obviously if we think they're doing 25 and the market thinks they're doing 3, there's a big difference. But I think the case for July, or the July scenario is a solid one, much more solid than the pricing would suggest.
Let's run with your scenario. Let's push it through the FX market. Steve, what does it change?
Well, look, I think that the dollar strength that we've seen has been driven a lot by the worry that, maybe the Fed's not going to cut, that the limit, some people sort of speculating maybe the next move is a hike. We don't think so. We think they're going to cut twice this year. I think if we began to see the Fed cutting and the beginning of a rate cutting cycle, because it's not going to be one and done, a lot of the dollar strength that we've seen could be eroded. Probably see carry trades, become even more fashionable. Things like the yen, which were sort of, kind of getting bid up because the market couldn't resist, 350, 400 basis point spreads. All of a sudden, if those spreads start compressing, sort of this sell yen story becomes a lot less attractive, especially if the BOJ begins its hiking cycle. So I think it would be a big deal. And I think it's qualitative as well as quantitative in the sense that there's a big, sort of bolus of fear in the market that the Fed's not going to move and that every central bank that cuts is doing it at its own risk. If the Fed sends a signal that it's going to move, I think that gets relieved and the willingness to sell dollars gets, is increased.
Steve, can we throw in some politics as well, the importance of voting? In Mexico, big win. In South Africa and India, tighter than expected election, sort of outside the G10 remit that you have, Steve. But just walk us through the politics and how important those elections are going to be this year.
I can barely deal with politics in, Manhattan, never mind, what's happening elsewhere. Look, we have written that, the big win in Mexico raises the possibility that, that they can make more dramatic moves. And we've kind of shifted our positive view on Mexico a little bit. But, let me leave it there.
Steve Englander of Standard Chartered. I'll let you leave it there. Steve, it's got to catch up, buddy. Can we bring up dollar yen again? Steve mentioned Japan just briefly. Bit of yen strength on the screen today. Report coming from the team here at Bloomberg. They're looking at reducing bond buys as early as June. This is the BOJ looking at reducing bond buying as early as June. A bit of yen strength on the screen today.
To me, actually, this is one of the covert stories that might become very much front and focus later this year. Torsten Slok over at Apollo is pointing out that if you get yen strength in tandem with potential rate hikes, it's hard for me to understand the cycle there, rate hikes at a time where people are looking at the highest yields long-term on Japanese JGBs going back to 2012, well, that could take a whole lot of the demand for treasuries away. So that on the margins could lead to higher treasury yields, considering how big a buyer base the Japanese have been for U.S. government debt.
Which explains why every single bond investor on the planet who's been on this program in the last month has been going to where? To Tokyo, to Japan. And not just because dollar yen's been close to 160 and they want a vacation. They need to understand what's happening in bond markets.
I mean, honestly, you need to understand what exactly the demand is. I will say, to be honest, one of the offspring is going to Japan on a class trip.
Oh, really?
We got a lecture from them about behavior and what there is the expectation.
Hang on a minute, the kids lectured you about behavior?
No.
The school lectured them?
The school about,
Okay.
For example, you should not be on your phones. You should not answer your phones on the subway. It's not like the New York City subway. Do not, swing around on the poles. Do not scream across the subways. It was this whole incredible lecture.
Animals or children? What's going on?
You haven't gone on the subway, and frankly, what's the difference?
True.
Moving on.
154.92, very respectful culture. Dollar yen there. Coming up in the next hour, this is what the lineup looks like. Wei Li of BlackRock, Bloomberg's Josh Wingrove, Boeing CEO Dave Calhoun sitting down with Bloomberg's Guy Johnson. You do not want to miss that. It's going to kick off at about 7:25 Eastern time, so look out for that conversation. We'll take about 15 minutes of it. It's going to be very, very cool to hear the latest from Dave Calhoun. And we'll touch base with Krishna Memani of Lafayette College. We've said it a million times already. We're only 2 days into the week. The calendar this week is absolutely stacked. After the weaker than expected ISM yesterday, the focus is going to be on the services ISM tomorrow, and JOLTS data a little bit later, an appetizer for all the jobs data you'll get through the week, including jobless claims on Thursday and payrolls on Friday. The second hour of surveillance up next.
It's a bit discouraging that we haven't seen a broadening out of the equity rally.
Only 3 sectors are beating the S&P this year. You have a steadily narrowing market.
I'm concerned that there's very little direct participation in this market.
We know that higher rates are weighing on these small caps, but appreciate that small caps are trading at a new relative low versus the market.
Diversification is really the opportunity that investors have in a flatter market environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. One of our favourite quotes of a good friend of this programme over the last couple of years or so has been from James Athey. Narrative table tennis, ping pong, back and forth, back and forth. Just 2 weeks ago, we had a hot PMI and we were talking about a hot economy. 2 weeks later, we had a soft ISM and we're talking about a cold economy. And we're putting more weight on commentary like this from Andrew Honhorse of Citi. Joel's data, a little bit later, job openings. He says this, jobs for April should show declining openings and hiring and quit rates at multi-year lows. Goes on to say, looking ahead to Friday, we project payrolls below consensus of 140 and a 4% unemployment rate on Friday, which means he's looking for rate cuts in July. Join Team Steve Englander of Standard Chartered.
Steve Englander actually pointing to data that's skewed by supply shocks on both sides and how we're underestimating the supply shock of immigration to skew the data to a more positive appearance in the labor market. I think it's amazing. Neil Dutta messaged me yesterday, and he said, "You'll be proud. Check it out. I've gone negative." He's never negative, right? He's actually recommending bonds, seeing a potential Fed mistake if they don't cut rates because of the weakness and the degree of weakness there is in the market. The only reason why I would say it's gaining steam and it's more than just narrative ping pong is because the Bloomberg U.S. Economic Surprise Index has turned about the most negative going back to 2019. This has caught a lot of people's attention.
So is everyone on Team Marco now? Marco Klanovic over at JP Morgan, who said this yesterday. A number of macro signals are pointing to economic slowdown or a recession. Pointing to yesterday. Market risk sentiment remains positive with stock markets near all-time highs. We talked about this earlier this morning. Does something have to give here? Does something have to give?
Perhaps. The question is what? Right? And this is part of the problem is that people are saying, yeah, you see weakness, which is the reason why small caps are kind of in a bad position, whatever they do. If they're Fed rate cuts for the reason of weakness, then you see sell-off. Yesterday, they actually were down, even as the NASDAQ was up. If you see potentially rates staying high, they're punished because guess what? They're more interest rate sensitive. It seems like there are pockets of the economy that have to give further, even if some of the big secular themes like artificial intelligence keep going.
Well, the commodity market's given right now. Check out the scores. WTI down for a 5th consecutive session. Yesterday on Brent, a break of 80 for the first time in February. This morning on WTI, your price of crude looks like this, 72.87 and down by 1.8%. In the bond market, yields 438.45 and equities were down 0.5% on the S&P. Check out the Russell. On the Russell, the small caps, this time yesterday up about 1%. This morning, down about 1%. We're negative 0.9%. Coming up this hour, we'll catch up with Wei Li of BlackRock on why inflationary pressures are here to stay. The Boeing CEO, Dave Calhoun, sitting down with Bloomberg's Guy Johnson. Do not miss that exchange. And Krishna Memani of Lafayette College on why bond investors can't catch a break. We'll begin with our top story. The latest economic data boosting the case for Fed rate cuts. Wei Li of BlackRock writing this. Even with anticipated rate cuts, we see policy rates in the US and Europe setting at a far higher level than they were pre-pandemic. As a result, we expect ongoing inflationary pressures and structurally lower growth than in the past across major economies. Wei Li is with us in New York. Good morning, Wei.
Good morning.
How much weight would you put on that number yesterday? That's got to be the first question this morning.
Well, it's not just that number. It's not just the ISM manufacturing. If you look at spending data that came out on Friday, it was weak. You look at the GDP revision, last week it was negative. So there has been a trend, right? So if you look at kind of the U.S. economic surprise indicator, it's taken a turn for a softer direction. So I would think that it's not entirely surprising that growth is cooling off from the elevated levels that we have seen. We always thought that the Fed wants to cut, and maybe this makes the case for them starting the rate cut this year.
Some people might make the argument then, weaker data, lower rates, let's buy bonds. Is this the moment to buy bonds?
Well, we still like equities better than bonds.
Why is that?
Because earnings are strong. U.S. earnings have just delivered the strongest growth in over 2 years, and margins are expanding in 7 out of the 11 sectors that we look at. So ultimately, we're seeing a bit of a, I wouldn't call it a big disconnect, but growth is cooling, but companies are able to continue to grow in the context of mega forces with AI benefiting the profit cycle. And as a result of that, equities are still well positioned, especially in the context of rate cuts coming. So yesterday we saw a bit of a bad news, somewhat good for risk sentiment.
Well, so let's dig into that. This idea of how far can the AI theme, the mega trend, go in a period of time where valuations are already so high? How much further do they have to go outside of NVIDIA, which has been the big gainer, with everything else kind of not monetizing it to the same degree and as quickly as many people previously thought?
For some of the notable names benefiting from the AI theme, earnings have been coming through stronger than price appreciation. So it's perhaps a surprise to know that NVIDIA, for example, is cheaper compared to last year this time, right? So if you look at some of the multiples, especially considering how quickly earnings have been guided higher. So I would say that there is more room for AI theme to play out, but we're not just looking at the obvious beneficiaries, Magnificent 7 has become Magnificent 5, but also thinking about what other sectors and companies that can benefit from the incredible infrastructure spend that is that needs to happen to support the AI megaforce. We're talking about data center, we're talking about energy consumption. So sectors like energy may well also benefit from this megaforce.
How selective do you have to be to avoid some of the pitfalls from what might be contributing to some of the weaker data that we're seeing for, say, manufacturing? I was looking at Michael Darda's research from Roth MKM, and he was trying to project out what this ISM manufacturing report would mean, particularly the new orders for forward earnings. And he said it would indicate a much lower forward earnings than currently being priced in. Do you agree? Is that something you can just simply avoid by avoiding certain companies?
Yeah, so the new order component from yesterday's ISM manufacturing was particularly worrisome because it was particularly disappointing. I would say there is a bit of a leading kind of quality to that in the typical cycle, but we're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude and also in terms of the speed of transition. So be very selective in terms of the beneficiaries of these mega forces is how we want to navigate the market environment rather than across the board.
It's a confusing moment on a lot of levels. Really confusing. One thing that people have been pointing to is it's a time to start being enthusiastic about Europe because you have stronger than expected economic data, the opposite trend than what we've gotten in the United States, and you have the potential for sooner rate cuts. They're going to cut Thursday, evidently, from everybody except for one person who's out there who doesn't believe so. But there is a question about why you shouldn't just aggressively go into Europe, which is getting the tailwinds of both better than expected economic data and rate cuts.
Yeah, so this Thursday is a really interesting moment because ECB has never cut when growth is improving, when inflation is way above target, and when unemployment rate is at record low. And they are going to cut this Thursday. They pretty much pre-committed to that, right? So, and they're also cutting before the Fed and before there is clarity around what the Fed is going to do next. So this is a highly atypical. But here we are. And if you look at flows, actually there has been a lot of interest into European equities for this very reason, not only from home investors based in Europe, but also from US investors as well, if you look at US domiciled ETF flows. So there is a appetite for European exposures, and we like them through an active kind of lens because being selective is still very, very important. Financials, for example, we have liked them for a while, industrials and energy, for example. This is how we want to play Europe.
Many officials on the governing council would make the argument they're independent of the Federal Reserve. How dependent are they on what happens here?
Well, it's quite remarkable. If you asked me at the beginning of the year, do you think that the ECB is going to go before the Fed? I probably would have said no. I probably actually have said no. So the fact that they're going this Thursday is truly remarkable. They will start first, but we don't think they will go far if the Fed doesn't follow. So there is this narrative of divergence as a result of the ECB going now, and who knows when the Fed is going to go. But ultimately, they're very related, right, through the currency effect. So
you think that narrative is overstated? That divergence that people are looking for?
For the very near term, maybe there is some credence to that. But over the long term, both central banks face high for longer structural challenges that push inflation higher. And we don't think that the ECB can go very far if the Fed.
A big argument for you and the team ultimately, and this is probably where we should finish, is that you think rates aren't going to back to where they were pre-pandemic. They're going to settle at higher levels. Inflation's going to be stickier than expected. How is this universe, this regime different? What's different about this moment than compared to, say, several years back?
Well, it's different because structural forces are shaping the macro environment and the market environment in a way that we didn't have even 5-10 years ago, right? So we're talking about aging population, we're talking about low carbon transition, we're talking about geopolitical fragmentation. So all of that points to inflationary pressures that central banks are now going to have to address and lean against. And all of that against a backdrop of high indebted levels, fiscal expansionary policy, no matter who gets into the White House later this year. So this is a truly different environment, and portfolios are sometimes hoping that we're just going to get back to the good old period, the Goldilocks period, but we need to position for high for longer.
Wei Li, thank you. It's good to see you, as always. Wei Li there of BlackRock. Some thoughtful stuff on financial markets and the regime we're in currently. Equity futures right now down by almost 0.5% on the S&P, with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hakes. Hey, Yahara.
Hi, John. A date has been set for Donald Trump's appeal to remove Fulton County District Attorney Fani Willis from the Georgia election interference case. Oral arguments are tentatively set for October 4th, making a trial before the U.S. presidential election on November 5th virtually impossible. Trump and 14 co-defendants are accused of trying to overturn his Georgia loss to Joe Biden in the 2020 election. The former president and others had pushed for Willis to be removed because of a romantic relationship she had with the special prosecutor. Intel's Pat Gelsinger is firing back at NVIDIA's Jensen Huang, who claimed that traditional processors like Intel's are running out of steam. Gelsinger saying, quotes, unlike what Jensen would have you believe, Moore's Law is alive and well. We see this as the fuel that's driving the semiconductor industry to reach $1 trillion by the end of the decade. Intel has fallen behind rivals, with revenue slipping over the last 2 years. Gelsinger was brought back to the company 3 years ago to help turn things around. And football's worst-kept secret is out. Kylian Mbappe is joining Real Madrid. The Champions League winners announced a 5-year deal with the French World Cup winner, meaning Europe's top club just got a whole lot stronger with the addition of one of the world's best players. Madrid has been chasing Mbappe's signature for years, and the move finally looks set to happen when he announced he would leave PSG earlier this year. That's your Bloomberg Brief. John?
Yahara, thank you. For football fans, if you're sick of Real Madrid dominance, you're going to be even sicker. He's 25, Vinny's 23, Jude Bellingham's about 20. This is going to go on for years and years and years. Up next on the programme, President Biden's border crackdown.
The reality is that people do claim asylum when, in fact, they are fleeing poverty, generalized violence, and that does not an asylum case make.
That conversation coming up next, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt, which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
The countdown to payrolls continues. Friday, 8:30 Eastern Time. We're looking for a number of about 185. That's a sneak peek of our survey for this Friday. The median estimate, 185. The previous number, 175. Equity futures on the S&P negative by 0.5%, pulling back after weaker than expected data yesterday. Yields lower yesterday, down a little bit this morning, down a basis point. Your 10-year, 4.38. In the commodity market, 5 days of losses. WTI down another 1.9%. Low 70s now on crude, 72.81. Under surveillance this morning, President Biden's border crackdown.
The number of encounters at the southern border is very high. The fact of the matter is that we have an extraordinary number of people claiming asylum and a greatly reduced number of people qualifying for it. The reality is that people do claim asylum when, in fact, they are fleeing poverty, generalized violence, and that does not an asylum case make.
So here's the latest. President Biden is set to sign an executive order today, effectively preventing new asylum claims by migrants crossing the US-Mexico border until levels drop by around 2/3 of where they currently stand. Bloomberg's Josh Wingrove joins us now from Washington for more. Josh, great to catch up with you, sir. Walk us through what you and the team are learning about what we could hear later today.
Yeah, this number is a sort of stricter number than had been kicked around. So Biden is sort of erring on the more, crackdowny side of things, for lack of a better phrase. Right now, we're talking about 4,300 a day, according to April data, people crossing between ports of entry. What Biden's trying to do is encourage people to go at ports of entry, and they have to make an appointment through an app called CBP One. I won't bore you with the details, John, but he basically does not want as many people simply walking across open stretches of the border. So what this would do is try to effectively close the border at 2,500 crossings a day, so below even where we are now, and not reopen it until they fall under 1,500 crossings a day, roughly a third of where we are now. So it would have to drop quite a bit. They're basically trying to put a billboard up and say, get in line, use the app, use the proper system. But this is almost surely going to be challenged. It's very likely a candidate to be modified, if not struck down. Biden himself has said they need a bill in Congress to make permanent changes on this. So this might end up being more a messaging exercise than lasting policy.
Can you walk us through that, Josh? It's complicated for a lot of people. Executive action, how much executive power he actually has over this issue?
It's a bit up in the air. He's trying to use something called Section 212F powers. Donald Trump used them as well. This is essentially a loophole that he's trying to drive a Mack truck through. And the courts are, going to at least take it up and look at it. They're going to be challenged by immigration rights advocates who say people have a right to claim asylum. The issue, though, John, is that a lot of people are claiming them. You heard the secretary say they're claiming them with false grounds or at least insufficient grounds. And the delays are years. We're talking like 7 years. So if you make a claim and then come in, you wait 7 years to get adjudicated or so. That's just too long in the eyes of the administration. But Biden is really politically jammed on this. He is having a big event at the White House. Progressives are mad, not going to come. They're already criticizing this as too onerous. The moderates don't like it either. It sounds like a lot of the swing state senators, particularly in the states that Biden himself needs to win, won't be there. And so right now he's trying to thread a needle, but it looks like he's getting the cold shoulder from both his right and center flank, or left and center flank, excuse me.
I want to ask you about the timing of why he's threading the needle this way now versus, say, 3 months ago when this first came to light in terms of a hot-button political issue, probably a little bit more than that. Why didn't he come through with this at that point rather than waiting until now if he had that executive power maybe all along?
Yeah, they've been saying they've been studying it, essentially figuring out whether they can roll the dice and get something done on this. They were trying to see if that bill would pass. Remember, the Senate has a bipartisan border bill that completely died in the House under pressure of Donald Trump, who said flatly that he doesn't want to give Biden a win on this issue. So Republicans in Congress don't want to do anything about this. Anyone you talk to about this, conservative, liberal, whatever, says that a bill would make more of a difference than an executive action. And so they were trying to get that bill revived. That itself was sort of a messaging exercise because Democrats brought it up knowing full well Republicans were still not interested in it. So that bill, for now at least, is still dead. And so Biden's question is, can I do anything, something, try to do something? And so that's what he's doing here with this. But he said publicly that they were looking to see what even they could try to do. They've been doing smaller stuff, but the big swings here, it's going to get challenged. And I should note, the big thing that the border needs is money. Money to hire people, money to sort of build out infrastructure, to process things, to hire judges, to speed up claims. Biden can't allocate money with an executive order and a flick of a pen. So even if he tries to do this, even if it survives legal challenges for at least a period of time, ultimately this comes down to people power and sort of boots on the ground. And right now the U.S. doesn't have that.
Are you saying basically that even if this is not necessarily overturned by a court of law, that it would not have any effect without congressional support financially?
It could have a short-term effect in removing people. It looks like these are going to be what are called Title VIII removals, so it's not like Title 42 under Trump in the pandemic when people were literally, pushed back across the border almost immediately. This would be a slighter delay. But right now, if you're looking at this from a workforce perspective or a labor force perspective, these claimants would not last for years. They would last much shorter periods of time and then be removed. Of course, potentially some wouldn't come at all. Hanging over this is Mexico's election. A lot of the decline we've seen so far this year, down from huge highs in December, has been because AMLO, the Mexican president, has cracked down. Now, of course, we've got a new president elected. She doesn't take office until October 1st. But in this interim period where he's sort of in his lame duck final months, the big question is, will he continue to enforce things? So to your question earlier about why Biden is acting now, it's because numbers usually rise in the summer as well. You've got a sort of Mexican presidential dynamic question hanging in the air. And he, I guess, is trying to get out ahead of that to prevent a surge, which, of course, would come in the weeks and the final few months before the U.S. election. He doesn't want to be heading into November with a border crisis, which, of course, is what Trump would be delighted to have happen.
Josh, there is definitely the political angles of this and how this plays out in November. There's also very much an economic aspect to this. As we were just speaking to Steve Englander, who's saying that actually immigration is the reason why the numbers on the jobs front look as good as they do and mask some of the weakness underneath. Going into next year, if there is not some sort of consensus or willingness in Congress to really pass anything broad-based, what power would Trump have if he were elected to really affect major changes to the border front himself?
Trump would probably try to use the same power that Biden's trying to use. He'd probably get caught up in the same legal mess that it seems like Biden is about to get caught up in. He would certainly go, I think, farther. He's also talked about doing mass deportations. So if it's a workforce perspective you're looking at here, it's not only with Trump a case of people not coming in, but being removed entirely. It's a dichotomy. It sort of dizzies the head. I've been on the campaign trail this year. I've talked to Republicans who say, like, their number one issues are both the border being unsecure and that they can't find any labor for their economy. I mean, these are two problems, of course, that could be a solution to one another, but there just is not an appetite right now in Congress for a bipartisan sort of grand immigration reform question, and that really is hanging in the air. I should note also that Biden has been trying to expand legal pathways within the sort of tight authority that the president has without Congress acting. We do not expect big announcements on that today on sort of new ways for people to legally enter the country. Instead, they're trying to just shutter the irregular crossings, quote unquote, people walking across the border, and steer them to the existing legal pathways, namely that CBP1 app, that one where you can file asylum claims.
Got there. Josh, thank you, sir. If you're dizzy now, wait 5 months. Dear me. Josh Wingrove of Bloomberg. Thank you, so. This from Terry Haynes of Pangea. He said this: Biden's been teasing border security executive action since February to respond to and show leadership on an issue that might determine the fate of his presidency. After all that time, the best the White House staff running the great and powerful Oz machine can come up with is a nothing burger that isn't decisive or effective, doesn't make a positive difference for Biden in crucial swing states, and satisfies no constituency except status quo Democratic progressives with whom the Biden staff likely curry favour to increase their post-White House job prospects. Come to think of it, that last one is probably the point. That from Terry Haynes of Pangea. Coming up in just a few moments, our Guy Johnson sitting down with Boeing CEO Dave Calhoun at the Berlin Aviation Summit. Don't miss that right now. Let's take you to Berlin, where Bloomberg's Benedict Camo is speaking with Airbus CEO.
Photo here of the blended wing aircraft. The next generation plane, do you think will still very much look like the aircraft that we're all used to these days?
There will be some significant differences, probably in the wingspan, in the size of the engine, maybe open rotor, so looking a bit different. The very futuristic blended wing design.
Equities negative by 0.5% on the S&P 500. The Nasdaq a little bit lower as well by 0.4. Keep saying this, but just an indication of how much this market has changed just in 24 hours. Yesterday, we kick off June. We're higher by more than 1% on the Russell. This morning, we're down almost 1%. We're negative 0.9%. And responsible for that is the economic data. I get it, but we're so sensitive to every single data point. And it doesn't take much for the narrative to whipsaw from one part of the story to the next very, very quickly. You see that in the bond market, 2-year, 10-year, 30-year. We have this hot PMI a few weeks ago, and 2-year yields start to threaten 5% again. Then you get this very cold ISM manufacturing number, and we get dragged all the way back down to about 480 on a 2-year. We're down almost a basis point again this morning. On a 10-year, 438.45. Just about unchanged there too on a 30-year, 453.56. And we're vulnerable to the same thing happening, Lisa, all over again. Later with job openings, tomorrow with ISM services. Again, when we get jobless claims on Thursday and Friday, when we get payrolls.
Is in line still a beat? This is sort of something that you raised when we got inline data for the economy that people viewed as, wow, this is great. We're not seeing an acceleration in inflation. Well, do we get the opposite response now if the bias is toward a faster than expected deceleration, if you don't get that upside surprise? I mean, truly, if you start to look at the potential for surprises, right now, are people looking for the confirmation of weakness and getting this nervousness around what happens if you don't get some surprise to the upside, given all of the negative surprises we've seen?
I think they're nervous in both directions. Just nervous in both directions, which is why this can change all over again tomorrow. In terms of the slowdown, the concerns around that, I think crude almost sort of spoke to those biases. If you had them yesterday, they were reinforced by the data and then again by this move in crude. So we've got 5 days of crude moving lower now. WTI in the low 70s at 72.87. Numbers we haven't seen since January, February time. Brent crude south of 80 for the first time since February. Lisa, Brent crude 77.12.
Okay, we've had trouble really characterizing if this is supply or demand. And then you asked Will Kennedy, and I was so glad you asked him because it verified that it wasn't just me struggling to really answer which is which. It's just unclear at a time when a lot of people just see this uncertainty. In terms of Wall Street, Matt Hornbach, a good friend of the show over at Morgan Stanley, came out with this base case, bear case, and bull case for the 10-year Treasury yield.
Give us the range.
Okay, his bull case is the 10-year yield falling to 2.8% by mid-year next year. The base case is 3.75%. The bear case is 5.2%. We're talking about almost 2.5 percentage points between the bear case and the bull case, which gives you a sense of how much of a truck you can drive through people's range of expectations.
Super wide, super wide. Under surveillance this morning, a few stories for you. Some key economic data due out at 10 a.m. Eastern time. We'll get jolts, factory orders and durable goods. Economists looking for jolts to show a third straight monthly drop in job openings. Pair that with ADP, jobless claims, payrolls. We should have a decent picture of the jobs market later this week.
People will be focusing on the quits data in particular for jolts because they can dismiss some of the headlines, the idea that somebody posts an opening that they don't actually need just so that they can get the maximum number of potential applicants. The quits data, though, doesn't lie, and this is something people talk about. If workers feel confident enough to leave their job voluntarily, that usually is a sign of a robust labor market. If they stop doing that, which is what's been happening recently, that's a sign of more nervousness that people take more seriously.
Let's go through the ISM together. This is the data we got yesterday. So weakest in 3 months, sub 50, in contraction. Seen a lot of that in manufacturing over the last year. 2 years. So that alone isn't surprising. New orders, the biggest drop since June 22. That's notable. What aren't people talking about? The employment component in the ISM manufacturing, because it wasn't bad at all.
Totally.
It's actually okay.
It came in better than expected. It actually expanded to 51.1 versus the expectation for 48.5. So how do you understand this? And people are kind of dismissing it because they don't understand it. And so this sort of goes back to Steve Englander's point. Is there some sort of other factor that is skewing the data, whether it's immigration or whether it's just simply a lack of workers left over from the pandemic? Or is there strength that we're just not measuring right in the other components? It is a confusing soup.
Spare a thought for the Federal Reserve because they've got to put some forecasts together.
Oh, you feel bad for them?
Yeah, new dot plot next week.
Who are they?
I think they're constrained by their own structure, which they're responsible for, and they can undo it.
There you go.
Okay?
There you go.
But I will say, within their own structure, I feel bad for them.
Okay.
But they can undo that structure if they want to. They don't have to put out a dot plot, do they? They could do something about that.
All right, so you feel bad for them because they've got to come together with some projections at a time of such great uncertainty, which really does raise this question of, do they just leave things the same? That's essentially what people are talking about.
Speaking of feeling bad for people, do you feel bad for this guy? Dave Calhoun, the Boeing CEO, sitting down with Bloomberg's Guy Johnson, a conversation you want to tune into. Let's take a listen.
You've obviously had a series of safety incidents that have put you back.
Yep.
You're seeing that reflected in the financials. You are now on a journey to change the culture of the business, to put the financials back on a more even keel. We see this day in and day out. Give me a sense of the timeline you're working with here. How long is this process gonna take?
First of all, the best answer to the question is it's going to take as long as it's going to take.
Yep.
And one of the flaws any of us can get into is to predict that moment. But I can predict circumstances that will define those moments. Everybody knows when this started. It was with a couple of horrific accidents where lives were lost. A company at that moment in time had a very difficult experience. What I call the lack of transparency, the unwillingness to take responsibility immediately. And I've been candid about that. I believe transparency of all things and relative to all cultures is about the most powerful word I've ever seen. Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. Because the minute you start to hide something in a big company, others notice and they might hide. And I'm not suggesting there was nefarious or anything of the sort. But transparency is like the most critical thing in the world. And when we started this, what I call the recovery moment, which was beginning of 2020, we made wholesale changes to the leadership team. We made began wholesale changes to the board. We stopped production of the MAX. 100%. So we went a full year and a month without producing a single airplane. Created a safety office based on lots of experiences that the FAA had working directly with airlines. Ironically, they mandated a safety management system for airlines, but not yet for the manufacturers of the supply chain in the industry. So we decided we would take that, we would learn everything that we could, create a safety office, and most importantly in that is stay tuned to the fleet, know what it's doing every day, all day, and then be transparent about everything you see and get good at that. So take that forward. And this is where I'll start to approach the experience we had with Alaska Airlines, which was the depressurization event and the escape of the door. So our supply chain and ourselves started production in the first month of 2021 from a rate of 0. And a workforce, while we hadn't laid it off, we had moved it to a whole variety of places around our factories, and then we had to move them back and remobilize all of that effort. At the same time, I haven't even mentioned COVID. That happened. So demand for airplanes fell precipitously, we know that. It also shut down our 2 factories because the first case in the US was right between them, literally. So we had a moment that's hard to describe, but then we had to begin the mobilization. And I would agree with everything Guillaume said about the supply chain and the ramifications of COVID on the supply chain. The turnover of experienced people, the loss of really important skills, and them coming back in a much slower and maybe a bigger word, sporadic pace than any of us had hoped for. Maybe we should have expected it, but at least we were hoping for better than that. So for 21 and 22 and 23, we were gradually bringing up the rates. Demand for airplanes came back faster than any of us ever imagined it would, and it came back in a robust way. We were increasing our rates, but a little bit of an issue began to arise. You may know, when nonconformance gets to your factory and you have the capability to fix it, you do. And you can do one of those and you do 2 of those, but when it starts to overwhelm the positions in your factory and you're doing more and more of that kind of work, or simply trying to accommodate a part that didn't show up.
Yep.
Didn't show up when it was supposed to be in position 2, let's do it in position 4. So this happens and it migrates into the factory. And I will say, while it was not the specific cause to Alaska, in my view, it was the systemic cause. It was the issue that created the opportunity a little bad behavior without a doubt on the part of somebody who we don't know yet. But it created an opportunity in the last position of a factory to then allow for an escape, which we are not allowed to do and never will be allowed to do. So that was sort of a short story of a long set of issues. But what do you do when this stuff happens? This is what I love about the industry, just for what it's worth. 1989, a United Airlines lost aircraft in Sioux City, Iowa, and there were many fatalities. I was at GE. It was a total moment for GE on the subject of safety, a complete overhaul of the business, the company, its approach to engineering, the maturity of design practices, and the allegiance to the skills that are required to perfect and mature a design practice. Lots of details, but it was an overhaul of the entire company. And I also remember when I came in as CEO at the end of the next decade, 1990s, it's like it happened yesterday. Every employee remembered it, they understood it. Their commitment design practices always started with a brief discussion on what happened in Sioux City.
Yep.
That's going to be us. That's going to be us. And I don't know exactly when that moment is when we're starting to feel really stable. I think in the engineering world and our commitment in the design space, human factors, all the things that led to the real tragedies at Lion Air and in Ethiopia, I believe that those fixes are in place, and now we're maturing, and we don't forget. And now I think in this Alaska moment and the escape that we got from our factory, I think the comprehensiveness of our plan, our willingness to take responsibility in the first instance, sent a clear message to all of our company that transparency will be paramount in this process. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan, it's not our regulator's plan. This is our plan, it's not our regulator's plan. They will provide oversight like they do, and they will regulate us, but it has to be us. We got to believe in it. We got to love it. We got to want to do it. And we got to take the pain that goes with slowing down the factory. We got to take the pain. And if we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror and we will be way better for it. And there will be a moment later in life where someone will look back and say, this may have been the most important moment in Boeing's life.
So what advice do you give to your successor? What kind of person does that successor need to be? You just laid out what needs to happen. What kind of person is going to be delivering that kind of plan? What kind of person would you like to see? What kind of person needs to be in your chair to do what you've just described?
Again, I'll just start with the word transparency. You just can't blink for a minute. There are no
But is it an external candidate? Is it an internal?
Yeah, no, guy. Well, I'm not going there. So we can go anywhere you want, but we're not going there. I will just tell you this: it'll be a deliberate process. It is.
Yep.
It has been thought through. They will get to a conclusion. It'll be a great one, and I'll be the most supportive player on the field.
But it's going to be an ongoing journey. This is not something that's going to be completed easily or quickly. What you've just described is something that happened over many years. Like, how symmetrical?
It's been, again, you're getting way too into this one. This process and the thought process around what it takes and what it is, who it is. And remember, I'm 67 going on 68.
Yep.
This is not like we woke up and here, let's go do it. It's a methodical, it'll be well done, and it'll be well articulated, and it'll be timely.
And Boeing will be a different company as a result of it? Or
it is. It is a different company. If I didn't believe that, I wouldn't go. Everything that we've put in place, our commitment to transparency, the extent to which we practiced it post-Alaska, the extent to which we practiced it post-Alaska, in full visibility to every interest that had been surrounding us for the last 5 years, made a difference. And it will continue to make a difference. And I believe anybody, and by the way, our board now is educated on what it means, anybody who comes into this role has to start with that thought process, that notion. And the rest of these initiatives and efforts, in my view, that'll be, the momentum's there, it'll continue. And if I always give somebody a warning sign, it's pace. It's the first question.
Take your time.
First question you ask me. When is it going to be done? Well, it's going to be done when it's going to be done. And be patient and keep the supply chain synchronized.
Are there metrics we should look out for? Are there metrics milestones that we should think about?
We posted the metrics that we're looking at. So they're transparent for everybody, transparent for our regulator. So yes, and what those metrics are meant to represent in a factory is stability.
How important is Boeing to America?
I believe it's the most important company in the world, and I'm not objective. But here's the thing. Our mission is to protect, connect, and explore the world. Just think for a second about each of those, how important they are to the world, and particularly now. I loved Guillaume's answer to the question on, do we need 4 or 5 more competitors? We need 2 great ones. And yeah, there will be a third.
Do we have 2 great ones?
There will be a third.
Do we have 2 great ones now?
Of course we do. Of course we do.
Okay.
Of course we do. We take off and land every second of every day. Every second of every day. We deliver safe airplanes. This is, in my view, no question about that. But just stop for a minute. There's 2 guys that do this, connect. The protect, which nobody really talks about with respect to Boeing, and the work that we do for our US military, and now way more importantly as we move forward, the growing work we do for the allied forces around the world who are all contending with new threats. That's a whole new, it's not a whole new opportunity, but it is an opportunity that is getting all the emphasis that it could possibly be getting. And as long as we continue to develop products that are relevant to those new threats, we'll be in a great place.
In terms of, let's just circle back a little bit. Do we need is there an engineering quality that you need to run this company? Do you need to get your hands dirty and understand what is happening on the shop floor? Is that ultimately
well, if the answer, if you're directing that at me like every popular media
No, I'm not. I'm wondering what, really what I'm asking you is the successor question. Is this an engineering problem? Is this a talent problem? Is it a...
It's no one problem. The engineering talents in our company are enormous.
Yep.
I've been hanging around a lot of engineering companies and interests for a long time.
You have.
I've never seen one with more breadth and more skill in my life. It has to be organized, it has to be applied in a disciplined way. With respect to a successor, they're not going to engineer anything. If they engineer something, that's when we should all run for the hills.
Okay.
Right? So they have to be keenly aware of where the engineering expertise lies and to make sure it's supported in every way it can be. And that it gets the last vote on everything. And it gets the last vote on everything. So that's what you do. Manufacturing processes, do I have to assemble airplanes? Does my successor need to assemble airplanes? No. Does it need to know the factory's stable? Does it have to have the metrics in place that provide for that? Does it have to have the resident skills and proficiencies in place to make sure that's the case? The answer is yes. And there is all of that. It has to be organized. We got a wake-up call to do it even better, and that's what we do. We just focus on it and just do it.
Again, coming back to the point you raised about competition, this is a point of disruption, though, in the industry. I'd come back to the sustainability question. This is a point of disruption in the industry. If Boeing's looking that way, is it going to be distracted from the disruption that is taking place in this industry, potentially? Are you, by having to go through this process, leaving yourself open to the disruption we've seen in the EV sector? You've only got to look at what's happening here in Europe with the car industry. There are others that are interested in what you do and want to do it better.
Yeah.
How do you make sure that doesn't happen?
Well, what we did, and of the things I'm very confident in, is what we did is we sustained all of the major technology research programs and development programs related to the technologies we think play on the next platform. All of these have to be developed, tested, matured, before you can actually design an airplane that incorporates it.
Yep.
And that's a lesson all of us have learned who have ever developed an airplane. Make sure you take the time to mature those things. But I feel very good about the portfolio of capabilities that we will bring to that airplane. Very good about it. And again, you take the time to make sure they're mature and ready. And there will be some significant changes as we go forward. Yes, efficiency is the one that we all talk about, but I think autonomy is another one that everybody should talk more about. Doesn't mean pilotless. It just means autonomy capable.
Okay, let's just think about that for a moment. We're struggling to certify derivatives of current aircraft. What do you think the regulators are going to think about? How much of a lag is there going to be in new airplanes coming to market? When do you think you're going to be, this is the question that you're not going to answer.
Yeah, exactly.
But let's assume that it's within the next 10 years. How long, let's say it's 10 years from now,
yep.
How long would it take to certify that airplane? And is that, how much of a slowdown in the process is that going to mean?
Yeah, I can't predict that. I will say this, we are an applicant for an autonomous civil vehicle with our small air taxi called Whisk.
Yep.
We're an applicant, and that means that the regulator has accepted the application, and that means they're organizing themselves to certify autonomy and to develop an approach that they can codify. And it's one of the big reasons that we're invested in Whisk. It's one of the big reasons, and I have a lot of confidence that that airplane will not only hit the market, but it will be deemed safe, and it will demonstrate that.
You talked before about how important Boeing is to America and to the world, but let me ask you a question. We're going to have an election in November. What do you want to see from the next administration? What does Boeing want to see from the next administration?
Yeah, well, everybody knows, I think, we're a company that relies on trade. Free trade to us will always be sort of first on the list of desires. I'll be the first to acknowledge that that seems to be going in the wrong direction and has been for quite some time.
You worried?
Yeah, I'm worried. I'm worried that the ramifications of isolation are going to, I don't want to overstate the word, but they're going to bring down economies. They just are. They just are. Now, I happen to be in an industry because choices are limited and because needs are great. It probably won't hit me first, but I worry about isolation with respect to the economic ramifications for lots of countries and lots of people. And isolation then breeds disenchantment, and disenchantment ultimately breeds political turnover. So that's the world I worry about with respect to isolation, and I don't like any of the signs I see.
Okay. How does that change the way you think about the way that Boeing's going to operate?
We're going to run hard, continue to build the world's best airplane, and then we're going to compete, and I'm going to lobby every day, all day for free trade.
Does it stop this? Does it stop the sustainability story? Does cooperation?
No.
I've heard building bridges a number of times today. What you're describing is not building bridges, it's blowing them up.
It's what I'm observing.
Yeah.
And I suspect you are too.
Yeah.
So we just have to be honest about what we observe. We have to express our concern for what may happen as a result. And those in industry, I think, have a pretty good picture on that. And then we have to lobby and convince the public and politicians that free trade's in everybody's best interest.
Is there a danger that the sustainability story ends up becoming, we went through the launch aid saga, we all remember that. Is there a danger that we end up balkanizing this process of sustainability, balkanizing the process of the next generation of aeroplanes, that there is no cooperation, and it becomes an effort that is driven by industrial policy with very domestic purposes in mind?
No, well, that's a description of an end game I have no interest in. I don't think it gets there. I really don't think it gets there. And it's with respect to this industry. This industry, we have allied nations supporting both supply sides. In my view, that will play well ultimately. We know we're going to have a competitor from China. We have a keen awareness for all of that. We should not be afraid of it. We should continue to develop technologies. I agree with Guillaume's comments completely. Just keep developing technologies the world needs and wants. Compete with the best of the best, in my case.
Yep.
That's Guillaume. He would probably say the same. We just keep trying to outdo each other, and that's where we keep running. I think a China competitor's got a long way to go on that front, measured in decades and decades, not in years.
How should government support Boeing and Airbus? How should government support the process of building the next generation of aeroplanes? How should government support the sustainability story that we're all hopefully on, the journey we're all on?
I think they have to mandate sustainability. I think we're all committed to it. So I'm not suggesting we need a slap in the face, but there are certain things that will have to happen policy-wise that create the absolute need and, more importantly, confidence that we are down that path. Yep. And that's all things sustainable fuel, all things sustainable aviation fuel. That's the answer that gets us even close to our objectives by 2050. So I'm in great favor of those kinds of policies, subject to the political side's understanding of what capabilities and timeframes are required to get there. And I believe we have tools across our industry. We have one we call Cascade, where you can do the math really easily, like in an hour, to figure out what policy objective will do to emissions in the next 20, 25 years. So, that's what we need to do. I don't think...
Guy Johnson just about to wrap up that conversation with Dave Calhoun of Boeing. Fantastic stuff. In the next hour of Bloomberg Surveillance, Krishna Memani and Samana to kick off the third hour.
You can forgive a lot of things if growth is remaining resilient.
Expectations of higher growth are now so built into markets. The two-way risk on growth numbers are now really significant.
I really think that the focus, at least for the second half, is going to be on the slowdown in growth.
That's sort of a perfect scenario where you can have deceleration wage growth, economy stays reasonably firm, and the Fed has this clear runway to do what it wants.
As long as the economy is expanding, we're finding opportunities. I think don't overthink it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City. Good morning, good morning. Equity futures negative by a third of 1%, trying to build on some very small gains in yesterday's session after getting absolutely whipsawed by the economic data. Plenty of potential to do that all over again over the next couple of days. Later on this morning, job openings, there are two. Tomorrow, you get the ISM services read. On Thursday, jobless claims. On Friday, payrolls. Coming up this hour, absolutely stacked 60 minutes for you. Samana of Wells Fargo on his call for a near-term slowdown. George Ferguson of Bloomberg Intelligence as Boeing grapples with more delivery delays. Fantastic exchange with the Boeing CEO, Dave Calhoun, and Bloomberg's Guy Johnson just moments ago. And JP Morgan's Kelsey Berro on why recent data means rate cuts later in the year. We begin with the big issue. Is bad news just bad news? Samana of Wells Fargo saying this: the economy is slowing gradually enough that economic surprises may trigger only consolidation. Election and geopolitical disappointments could trigger larger pullbacks. Alongside Samir, we're joined by Krishna Memani of Lafayette College. Gents, great to catch up with you both. Samir, first to you. Is bad news just bad news? And could you define for us this Friday, when we get payrolls, what bad news looks like?
Yeah, John, as you know, we've been cautious for some time, and a lot of that caution has been driven by the fact that the Fed raised rates so precipitously over the last couple of years. And although those kind of long and variable lags might be a little bit more long and a little bit more variable this time, we've thought for some time that the economy will slow. As far as Friday goes, the tricky part is, there's going to be some who are hoping for rate cuts to come back to the forefront. For those folks, they'll clearly want a worse number. I think the tricky part for us, though, is we tend to be more fundamentally driven. And if you do get a worse number, at some point you do have to deal with the slowdown on the way to those rate cuts.
Krishna, let's talk about what bad actually is. 125 over at Bank of America. That's bad news. Apparently, Stuart Kaiser of Citi, who'll be catching up with later this week. Headline payrolls below 150 would be worrisome. What is bad this Friday?
Well, so I don't think 150 would be such a bad number. I think if you kind of put 150 in conjunction with GDP now coming down from 3% to 1.8, you can make that case. But I think in the sequence of things that we have seen and the variability in employment, I don't think 150 is a really bad number. The point I would make to kind of counter what Samir was saying was, there will be a slowdown, and we have been hoping for a slowdown. But there is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way. I think the Fed would like to see that, but there is really no evidence of that just yet.
Hold on a second, Krishna. A lot of people would disagree with you. Even Neil Dutta is actually getting not as constructive as he has been in the past, partly because what you are seeing under the hood is ISM manufacturing coming in lower than expected. The U.S. Economic Surprise Index falling to its most negative going back to 2019. Why is that not enough to say that things are slowing?
I mean, things are certainly slowing from a very rapid pace. But I think if you have your growth rate at 2%, at this point in the cycle, after 550 basis points of rate increases, I don't think that is really would be considered a meaningful slowdown. That's the point I'm trying to make. That is, if we stay at 2%, which is what Neil says, he DM'd me at 2 a.m. last night to kind of confirm that. The fact is, if it is at 2%, then that's really not a slowdown at this point in the cycle.
All right, Samir, so what would you say to that, given the fact that we've been grappling with this for a number of months now? What is slowing but not slow, right? What is sort of the normal cooling that is positive versus something that is nefarious?
I mean, first of all, I want to know I'm not in this DM group at 2 a.m. at night. But, away from that, I mean, look, I think the tricky part is, like I said, those lags have been longer and maybe a little bit more variable. But every time somebody goes to refinance, they pay a much higher interest rate than they did the last year, the last 2 years, the last 3 years, right? So, again, that is creeping into the economy. You have seen it on the lower rungs. I think, typically it tends to go up from the lower rungs to the upper rungs, and I think you're seeing that. I think you're also seeing, whether it's all-in yields on long corporates and high yield also creep up. I know spreads are low, but the amount that the companies are paying has gone up. So I think from that standpoint, what we see is a little bit of a saucer in terms of things come down, they settle into kind of a new normal, and then eventually, you reaccelerate once kind of savings have been rebuilt and people have kind of worked off some of the excesses.
You're looking for that recovery in 2025, a recovery to a slowdown that Krishna says hasn't happened yet. Samir, can you help us understand the next 12 months and how you think this plays out?
So I think for markets anyways, I think probably the next few months are going to be very choppy. I don't anticipate new highs in 2024 until maybe after the elections. And again, I think that's depending on when we finally get kind of clarity around the elections, which, possibly could push into late 24, early 25. I think once we get that clarity, then I think the markets can kind of figure out, all right, which set of stocks will do well kind of in this administration, whoever that might be. And then I think, we do make new highs probably in 2025 alongside that economic recovery.
Do you share that view?
Well, I think the overall trend for asset prices is probably higher. I don't think it happens in early 2025. In a lot of the policies that will be implemented after the election, I think if there's a driver on the upside, it's probably going to be driven by that far more than the election results themselves, because there'll be some amount of uncertainty. But having said that, though, I think from an economic perspective, things are at a good place. The real question is, how do you kind of incorporate that okay economic news in the context of valuations and likelihood that inflation remains somewhat elevated relative to what the Fed would like it to be?
I love this, right? You guys have different kind of economic outlooks, perhaps, but you might have the same actual investment thesis. You're still just saying T-bills and chill.
Well, T-bills and chill, because I think the summer is basically lost, like the second quarter was lost. And since things started not slowing down in February, it became quite clear that we are going to be in this range-bound market for quite some time. And that is how exactly it has panned out. Doesn't mean that things cannot go up. It's just that we have to catch up to valuations, let the economic growth run, and let's see if inflation slows down.
Samir, are you T-bills and chill as well?
We don't mind the short end of the curve, but I think as we kind of approach the upper fours on the 10-year, I think we would like to lengthen duration. I mean, I don't know if it takes 6 months or 12 months for the Fed probably cuts. And at that point, probably you will see people start to extend duration. We want to be a little bit ahead of that. I think, from a market standpoint, from an investing standpoint, I think the nice part for investors, and we've been on the right side of this, is if you're in large caps, you get better profitability, better quality, better performance. That doesn't happen very often. So right now, you can fade EM, you can fade small caps and kind of concentrate more on the larger cap side and be okay. And I think that's kind of the way to approach the next few months.
Krishna? I think the point Samir is making is a really good one, which is if you look at the markets and you kind of see which market has a higher potential of running away from you in a hurry. I don't think that's equity market, and I don't think that's bond markets on the negative side. I think if it is, it's bond markets on the positive side.
So yields dropping.
Yields dropping, bonds doing much better. I think if you wanted to take a punt on the risky side, that's the punt I would take rather than the other way.
You mentioned the politics, Samir. Let's talk about that. This is what Peter Cheers basically said. Both candidates are troublesome for bonds. And we'll get more and more clarity on that as the year grows older. Samir, what would you say back to that? For someone who's looking for that recovery in 25, there are others who are pointing to the bond market as troublesome. Maybe the recipe for a problem in equities because of what may or may not happen come November.
Yeah, look, I think with bonds, you have to be very disciplined because, again, you do have kind of this fiscal profligacy in Washington. So I think, again, if you push north of, again, 475, I think there's some value in fixed income, especially if there is some disappointment on the economic side, right? You've got to kind of traverse this path of bad news to those Fed cuts. So I think at 475, that probably makes some sense. But if then you fall back down into the low fours, high threes, I think you have to reconsider and possibly close out some of those tactical longs. So I think at least for Treasury, especially on the longer end, I think you're going to have to be very nimble, but I think there will be opportunities.
Still really early days. It's early June. Is it too early to talk about November?
Oh, yes, very much so. I think there's a great deal of uncertainty.
When do you start to consider it?
Well, I think when the picture gets slightly clearer, which is never. The point is right now, in terms of political developments, it's still very early and very uncertain. I think within a few months, things will start crystallizing a bit more as to who's getting more traction.
That said, what's the bigger risk right now? Because we've had numbers of guests come on and say the bigger risk is that the Fed cuts rates now, and then whoever wins in November is going to announce some big fiscal package, including prolonged tax cuts, including potentially tariffs, and that could send inflation higher and push yields higher. Do you buy that?
I think that is certainly a risk. I don't buy that because I don't think the Fed is cutting rates anytime soon. Because I think for the Fed to cut rates anytime soon, especially ahead of the election, things have to slow down in a more pronounced way than they have done so far.
Samir, this is actually an interesting debate that's percolating, and honestly, I don't get a good sense of where the majority of people stand. What is the balance of risks right now for the Federal Reserve? That they're too tight or too loose? I mean, honestly, we still don't know.
We don't. And again, look, it's a bifurcated economy. And so you've got people who can make really good, solid, well-reasoned arguments probably on both sides, which is why I think there's, these opportunities that are kind of being underappreciated by markets. So I guess what we've done is maybe taken a step back and looked for, secular trends, right? Things that will probably do it regardless of whether the Fed cuts or doesn't cut, regardless of who wins the White House. So I would go back to energy, industrials, materials. All are involved with AI and, decarbonization in some ancillary ways. And then healthcare, right? All of those areas can grow earnings. They trade at reasonable valuations. Maybe you don't fully outperform, but you at least participate without having to lean into probably the most crowded trades.
What about the bond offset on the long end?
So again, I think if we get those markets come to us, I think that's a great offset, right? You pair kind of some of those cyclical areas that are cheaper, maybe play well in an okay economy with kind of that hedge on the longer term fixed income side. Because again, if you do see a rough patch, those short term yields will melt very quickly.
Final word, Krishna.
Yeah, I think the interesting thing about the bond market is we can worry as much as we want about fiscal profligacy and all of that stuff. But the moment you see a sign of a recession arriving, that's it. We are rallying massively.
Pause. What does that look like? The moment you see a sign of a recession arriving, some people think we might have seen it already.
Well, again, it's not in the data. You might have seen it. It doesn't exist. But the fact of the matter is, I think I've
got to wait for a group of economists to look back 12 months and say there it was.
Well, for that to happen, I think consumption has to slow down significantly more, and employment has to, the growth has to taper off, and you have to start losing jobs. There's no sign of that just yet.
Krishna, thank you. Big week of data. Appreciate your time. Krishna Memani alongside Samana of Wells Fargo and Lafayette College, respectively. Equities right now down 0.4% on the S&P 500 with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahira Hackers. Hey, Yahira.
Hi, John. The Indian rupee fell the most in a year as vote counting started following this weekend's election. Early results indicate the race is much closer than any of the exit polls estimated. Narendra Modi is seeking to extend his decade in power by another 5 years. But initial tallies indicate his ruling party is poised to lose its majority in parliament. Donald Trump's campaign says it raised $34.8 million in under 24 hours after his guilty verdict was announced. It's a signal of how the former president is using his legal troubles to rally support. Nearly 30% of donors were first-time contributors, according to his campaign. And Novak Djokovic came back to win an electrifying match in the fourth round of the French Open. The tennis great fell behind 2-1, but stormed back to take the match in 5 sets. The win gave Djokovic a record 370th Grand Slam win, passing Roger Federer for the most in tennis history. He pushed through a painful knee injury after slipping on the clay court. In a sting stand, he has not committed to continuing in the tournament. That's your Bloomberg Brief. John?
Yahara, thank you. I'm convinced he's playing with us, but we'll see. More from Yahara in about 30 minutes' time. Up next on the programme, some morning calls for you, plus George Ferguson of Bloomberg Intelligence as Boeing works to address supply chain issues. We'll recap some of that conversation that Guy Johnson had with the Boeing CEO, Dave Calhoun. Right now, equity futures, negative 0.4%. Your opening bell, 1 hour and about 16 minutes away. Live from New York, welcome to the programme. Good morning to you all. Equities are negative by about 0.4% off session lows. Yesterday, a really wacky day. Equities were okay, and then they got hammered by that ISM manufacturing read. Let's see what happens a little bit later, but ultimately the close was a decent close, just about positive to kick off the month of June. In the bond market, the bid's back, yields are lower. We're down 2 basis points on a 10-year, 436.49, and crude still selling off. We were lower a little bit earlier, but still down on the session, 1.7% lower, 72.97 on WTI. Let's get you some morning calls. First up, Mizuho raising its price target on Nvidia once more to $12.75. The analyst, a good friend of this program, Vijay Rakesh, cited the chip giant's most recent announcements, including a new Blackwell super chip and also seeing the upcoming stock split as an additional tailwind. The stock is just a little bit lower. We're down 0.1% in the pre-market. Your second call from Barclays, maintaining an underweight rating on Paramount in light of a new takeover offer from Skydance. The analyst saying that the latest deal does not provide much upside to non-voting shareholders, and neither does it address key friction points. We're down there about 1/3%. And finally, Wells Fargo raising its price target on American Express to $2.75. The analyst predicting strong international growth over the next decade plus. We're down 1/3% there too. Sticking with the consumer, airlines continuing to grapple with demand amid capacity pressures as summer travel continues to pick up. Many carriers impacted by Boeing's delivery delays. Earlier, the CEO, Dave Calhoun, sat down with Bloomberg's Guy Johnson.
Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan. It's not our regulator's plan. If we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror.
Joining us to discuss is George Ferguson of Bloomberg Intelligence. George, I'm sure you watched over a lot of that conversation. Great exchange with Guy Johnson and the Boeing CEO. What stood out for you?
Yeah, so I guess we continue to hear about the extreme demand for airplanes and Boeing's desire to fill them. Understandable, that's his job. I guess as we look at it, we don't know that there's that big of a miss right now in the number of airplanes in the marketplace. We just don't see the profitability. What we see more is sort of Boeing's challenge here of slipping market share.
Key feature of the conversation at the beginning, and a feature of the conversation that Dave Calhoun didn't really want to indulge, was succession planning and what was happening there. And he referred to his age. George, he talked about being in his late 60s, which sort of alluded to this point that they'd already been thinking about it, which makes me wonder, if they've already been thinking about it, why is it taking so long?
I mean, I really think that they hadn't been thinking about it until Dave Calhoun had tendered his resignation. And so it seemed to me like the board was flat-footed. I think it's a really hard position to fill. I think I've said previously, I think you really need a rock star. I think you need someone who's going to be a very good operator, factory operator, have some engineering talent, as well as have a mind for financial statements. I think it's really hard to fill, especially I think it's hard to fill in America right now. We've pushed a lot of this manufacturing work overseas. And so I think it's a tall order, and I think that's why it's taking so long to figure out who it's going to be.
George, is Dave Calhoun considered a rock star in the corporate world?
I don't think so, right? No, I think Dave Calhoun has done a nice job of coming in and filling a gap between, a CEO that just didn't make it, Muhlenberg. I think he's tried to cobble things together here, but I would not call him a rock star, right? A rock star is someone like Larry Culp out of GE who really knows how to operate factories.
Seems like everybody just always comes back to Larry Culp. It's sort of when can he take over? Please come.
Yeah.
There is this issue also with Dave Calhoun talking about how Boeing is an entirely different company than it was before some of these events transpired. Do you agree with that? Does it look like a totally different company?
Well, I think it does look like a totally different company than prior to the pandemic, and I think it's because they lost a lot of really good talent during the pandemic. So to me, it looks like a company that's endured a lot of turnover, is really in search of its next leaders, not only, I think, up at the CEO level, but down on the factory floor level, right? I think they've lost a bunch of talent there. They're about to go into union negotiations for the most important union, later this year. For pay packages and that workforce structure going into the back half of this decade, that'll be super important. But right now, it doesn't look like a better company, than it was pre-pandemic. It looks like a challenged company. So it's different, but it's challenged.
You've talked about those challenges before. George, could you walk us through that? Are they structural issues? It wouldn't matter who was running this business, they'd have to confront the same issues. Or is it something else? Is it about execution?
I mean, I think it is all about sort of execution, people, training. And I think Boeing has kind of lost its way, probably even since the 787, where they were really trying to outsource as much as possible away from Boeing factories. I mean, that's the story behind Spirit as well, right? Outsource away from Boeing's factories, look for lower cost labor, look for the suppliers to bring some of the engineering so they could just be assembling airplanes and I guess counting the cash. And I think what they've learned is you just can't do it, right? It's aerospace is just too hard of a business. The tolerances are extremely tight in this business. Quality is super, super important. You've got to build into your people. You have to train them. You've got to build the right system so when there's problems, it gets fed up to management. So when I read the reports that are coming out of Boeing, what I'm reading is just a breakdown in someone's ability to manufacture products well. And they've got to go back to that core.
George, Dave Calhoun really dismissed the idea of competition, this idea that somebody else could get into this field with any rapidity to really challenge them. At the same time, on the margins, I do wonder the significance of China ordering 100 Airbus aircraft overnight. This idea that this is a departure from the past, the largest and the first expenditure like this by China in a while, and may come at the expense of some of their Boeing purchases.
I agree, right? And so there is no, I think, third party that could step in quickly to this industry. Even though the Chinese are working on an airliner right now, I just don't see them having the ability to ramp up production and deliver a lot of airplanes. So I think from that standpoint, Dave Calhoun's telling you it's just two of us. But the risk here is that Airbus is going to take more market share. And I think you don't always play for market share. But I think to me, one of the bigger problems is that the more you move to higher rates, as Airbus moves to higher rates, they're improving the flow through their factories and their suppliers' factories. And that's improving the health at their suppliers. That's improving the skills at their suppliers. So Boeing runs the risk, if they're not ramping up production, doing it well, that they're going to leave their supplier base in a weaker position, and that makes it harder to get those high levels of builds later on in the cycle. And so I think he needs to be concerned about market share here against Airbus, because again, it feeds into the health of his supply chain, and that's super critical right now.
George, just quickly, for the US carriers, any evidence that those airlines need those planes, like quickly and right now, given what we've heard over the last week?
Oh, look, some of them do need it, but I'd point back to the American results. The pre-announcement of their revenue problems, right? To me, it seems like the U.S. full-service carriers doing pretty well. Most of them, United, Delta, American a little weak. I think there's revenue issues at the low end of that airline market. It's at the low cost. It's at American. They're putting a lot of capacity in the marketplace. I don't know that they need all these airplanes.
Interesting, George. Thank you, sir. George Ferguson there of Bloomberg Intelligence. The airline's quite a story over the last week.
Especially given the bifurcation, as George was alluding to, in terms of the well-heeled consumer who's traveling to Europe to take advantage of the foreign exchange differential.
Or Tokyo.
Or Tokyo, exactly. Or the others. And that's what you're seeing. I will just say this poll just crossed, showing that almost 2/3 of Americans who are considered middle class say they are facing economic hardship and that they don't see their prospects getting materially better. So it's being borne out in a host of ways.
We've heard it repeatedly. We'll talk more about it in just a moment. It's a big week ahead for economic data. We'll break it down for you with JP Morgan's Kelsey Berro and Bank of America's Aditya Bhave. That conversation is just around the corner, live from New York City. This is Bloomberg. 60 minutes away from the opening bell, equity futures negative, down here by 1/3 of 1% on the S&P. The Nasdaq negative by 1/3 of 1% also. The Russell off by 3/4 of 1%. Switch at the board and get to the bond market. The scores look like this. Yields are lower. Once again, we're down 2 or 3 basis points on a 10-year. 4.3610 on a 2-year, down another 2 basis points. 4.7870. This rally in the last 24 hours inspired by a weaker than expected manufacturing ISM.
Yeah, basically this idea that maybe the Fed even might have justification to cut as soon as next month. This is increasingly some of the belief that we're getting from the likes of Steve Englander and others. There is another question, too, which is at what point is that good news for the stock market? At what point is that bad news? You say yesterday the market kind of, eked out an okay kind of finish. The Russell didn't. And I keep going back to this. They seem to be kind of not in a good place regardless of what
I love
happens.
how people tried to explain yesterday. They're like,
Yeah,
the data's
I would
bad,
agree.
stocks are down. Then later in the day, now people think maybe the Fed's going to cut rates. Stocks are up. I mean, what a ridiculous 24 hours.
I mean, honestly, it's been sort of the way of the year. It's been basically, what is it, ping pong, table tennis in terms
James
of narratives.
Affey.
So today I was thinking maybe we've got to change the narrative, that people are thinking that we're getting actually some sort of weakening and, maybe on the margins, but it's just, I think people don't have a sense of a compass right now.
Hardest job in the newsroom, I've always said this, the person who has to write the market update 5 times a day. Not once, like 4 or 5 times. Update, update, update. I feel sorry for them. I do. I feel bad for them.
I can honestly say that if either you or I had to do it, it would be like, you could
I
see
do
the
it once
frustration.
in the morning.
I know, but you
I don't
could
have to do it again in the afternoon.
But you would then say the frustration. We don't understand. You can't write that in every story.
Yeah, I'm not sure anyone wants to read me just saying I don't understand. But anyway, crude looks like this. Brent, WTI, 5-day losing streak. Down for 5 days on crude. WTI down to about 73. Erasing some of this morning's losses, we're down 1.6%. Brent crude, it's a break of 80 for the first time since February. It's notable, 77.23.
A lot of people pointing to the fact that OPEC Plus surprised with a resumption of some of the output that might have been taken offline for the next couple of weeks, next couple of months in October. I don't really have a good handle on this, though, either. And honestly, neither did Will Kennedy. He said there's a supply aspect, there's a demand aspect. At the same time, airplane travel seems to be going gangbusters. So, again, hard to know exactly what's driving this. But right now, OPEC Plus seems to be the narrative du jour.
A little bit softer again this morning. Under surveillance this morning, some top stories for you. Roaring Kitty is back in the spotlight. Sources telling the Wall Street Journal that E-Trade is considering removing the meme stock leader, Keith Gill, from its platform. E-Trade and its owner, Morgan Stanley, are concerned about potential market manipulation. GameStop shares moving on the back of Gill's recent social media posts showing his massive, and I mean like monster, position around this name?
People saying that if the gains stick, he stands to gain something like $170 million, something in that order from the options trading. There is this question of what is manipulation. I mean, this is pretty blatant manipulation if you believe that putting your beliefs out there can drive a mob to go buy something, but it's not covert. He's not really hiding anything. It's really clear what he's doing. So it raises a lot of questions around both the legal liability for these companies and, as you pointed out earlier, the business liability of going after someone who is so incredibly popular with a pretty mass cohort of meme stalkers.
It's something that, according to people familiar with the internal discussions, they're discussing at E-Trade. I mean, I'd love to be on a fly on the wall in that room right now.
Yeah.
What are the big concerns for them if they remove him from the platform?
The lawyer on one side. Guys, this potentially could be really bad. The CEO on the other side, this potentially could be bad in the other direction.
Head of marketing.
Exactly. So, either way, they seem to be in a tough spot.
It's a story to watch throughout today. Looking forward to more reporting from the team as well around this story. Let's turn to this one. President Biden cracking down on immigration. Bloomberg reporting he'll sign an executive order looking to prevent new asylum claims by migrants who walk across the US-Mexico border. The move would stop claims at the border if crossings hit 2,500 a day. We've been talking about this since when? I think February, when this really started to get to boiling point down in Washington, and there was this bipartisan effort on the table in Congress, waiting to see if he had executive power. They're going to go forward with this, and most people think it might be dead on arrival.
Well, it might be dead on arrival for two reasons, and this is what Josh Wingrove was saying with Bloomberg News, that basically on one level it might be overturned by the courts, and on the other level there isn't the staffing or the finances from Congress to really make this effective in any kind of concrete way. It also raises a question, though. A lot of people think that if Trump gets elected, he could single-handedly do a lot of things on immigration. If the courts overturn this, how much does that curtail the ability of the next president, whoever that may be, to unilaterally move on the same issue? There are a lot of interesting implications that I see in this.
That have big economic consequences around numbers we'll be talking about on Friday. Busy week of data underway. Weaker than expected factory data sparking a rally in treasuries yesterday. ISM manufacturing falling to the lowest level in 3 months. Next up, 10 a.m. Eastern Time, JOLTS data, factory orders and durable goods. Joining us now to look ahead to the week ahead is JP Morgan's Kelsey Berro and Bank of America's Aditya Bhave. Let's start with you, Kelsey. First of all, on that calendar, and we can bring that calendar back up, hopefully, payrolls on Friday, jobless claims on Thursday, the ECB, we've got the ISM services read tomorrow as well. Take your pick on this calendar right now. What stands out for you? What's the big one for you and the team?
So I think the hard labor market data is really what is important to us, because when we look at the Fed's reaction function, we think it's becoming more asymmetric, meaning that the Fed is going to be more sensitive to weaker economic data than they are to continued strength. Continued strength is what we all expect, right? So it's interesting when you talk about something like the ISM manufacturing report, which apparently drove the rally in yields yesterday.
You say apparently.
Well, ISM manufacturing has been below 50 for 16 months in a row. It popped up above 50 in March and then fell back below 50 for the last 2 months. So essentially, the soft data has been telling us that the economy stinks for quite a while now. And it's the hard data that is actually going to move the needle. So you need to be looking at things like claims, like JOLTS at 10 a.m., and the unemployment rate and job growth on Friday, because that's what's going to shift the Fed's mindset from fighting inflation to protecting the labor market. We're not there yet, but that's what we're watching.
Let's pick up on that distinction. So it's soft data versus hard data. Aditya, do you think we're being misled by the survey data?
I think we focus on the hard data, as Kelsey said. For the jobs report, we're pretty optimistic. We're looking for 200,000 in job growth, which should be just fine. That's trend-like. That keeps the Fed very firmly on hold. Our view has been on the Fed that nothing changes until something changes. In other words, the data aren't strong enough for the Fed to worry about hiking, but the data aren't weak enough to warrant rate cuts just yet. And we're very much sitting in that space very comfortably right now. As Kelsey said, focus on the hard data, focus on the jobs report. That's really where That's the star of this week's show.
You say, as Kelsey said, but Kelsey also said the economy stinks and has been stinking for quite a while. Do you agree?
Well, she said the soft data are telling you that the economy stinks.
Thank you.
GDP growth was more than 3% last year.
Established Lisa's bias, not Kelsey's thoughts.
GDP growth was more than 3% last year. In that entire period, the manufacturing-ism was under 50. So if it pops above 50 very narrowly for a month and then goes back down below 50, you take that with a grain of salt. The U.S. is not fundamentally a manufacturing economy, right? It's a services economy. It's a consumer-driven economy. And the consumer, for now, looks just fine. I mean, you talked about air travel. Over Memorial Day, for that week, we had more people flying than in any week last year, right? We set a record. Above the summer peaks, above the Thanksgiving peak, the Christmas peak. So you're probably going to see even stronger summer travel this year. And personally, I'm not flying this summer for that reason.
Really? Well, I know that some people on this set did actually travel on Memorial Day weekend and had fine experiences from what I can gather. I'm wondering, though, Kelsey, not to mischaracterize what you're saying, but you do see enough weakness to validate the idea of Fed rate cuts later this year. Yeah. So I guess what gives you that confidence if the soft data has been stinking for quite a while, not necessarily the hard data, but it's kind of left people in this level of uncertainty debating whether the Fed is too hot, too cold, basically what their biggest mistake could be.
So if I think about how we've been positioned so far this year, the first 5 months this year, our game plan was to embrace the soft landing, to lean into credit, to lean into high yield, and to put less of our risk budget on duration. Now, there was a reason we still like duration, and that was because of valuations and the skew. The skew meaning the Fed's done hiking. We think the bar to restarting hiking is very high, and there's a ton of policy space for the Fed to respond if things start to weaken. And I think there's a limit to the painless labor market rebalancing that we've experienced. So, for example, job openings have come down, the unemployment rate hasn't gone up. The quits rate has come down, the unemployment rate hasn't gone up. Now, that can persist for a period of time, but I don't think it can persist forever. So again, we're watching that labor market rebalancing, but I think the next move that the Fed is going to make is ultimately going to be one that protects the strength of the labor market rather than one that in which they need to be fighting inflation. We do think that inflation generally is under control. The majority of the inflation overshoot we think is lagged, compositional. It's generally related to housing, and secondarily for CPI, it's auto insurance.
Is that preemptive? Is that policy protection preemptive? Do they do that before they see weakness in the labour market, or do they have to wait to actually see it?
So when we look back at history, pretty much every rate cut is initially considered preemptive until it's not. So, I mean, if you look at what the market prices, when the Fed is doing their first cut, they always underestimate the amount of cuts that are actually delivered. And so, yeah, I think it probably will be viewed as preemptive initially, but then we'll have to see if it will be enough.
Aditya, do you agree?
I'd say on the Fed, not so fast. We do have the first cut in December, but you have to recognize that over the last 4 months, the core PCE has been running at 4% annualized. Right? The April data, that was viewed as a big improvement. Well, guess what? We still annualized to more than 3% in April. So there's still some ways to go for inflation to come down. I agree that some of it is housing, but they can't look through that, right? Because you just can't cherry pick in the situation that the Fed is in right now.
One of the backdrops to this is uncertainty around immigration. We were talking earlier to Steve Englander about that and how much that has been a supply shock in a way for the labor market. The other aspect is just fiscal stimulus in general that Aditya, I know you've been pointing to as still being a tailwind to economic growth. How do you factor that in as something that is the new normal or continuable or something that isn't going to run out?
Right, so it actually does look like the fiscal impulse is fading. If you look at the first quarter GDP data on both public and private investment, you got this very large surge in public investment as well as manufacturing structures, which was related. The public side was related to the IIJA, the private side was related to the CHIPS Act and the IRA. Big deceleration across all of those components, still growing, but much slower in the first quarter. So it looks like that stimulus that impulse to growth has run its course, which makes sense, right? Because at a certain level of investment, you can continue growing the capital stock, but investment doesn't need to keep growing. And I think that's where we are right now. So the fiscal impulse seems to be fading. That means that broadly supply shocks are becoming less of a story, and it's more of, is demand going to accelerate or is it going to cool off?
You've got tons of data on bank balances, what people are spending month to month. What's that data telling you at the moment?
So it still looks like spending's holding up pretty well. It's a little bit difficult to translate the daily data into monthly growth rates, so we still don't have a forecast for May retail sales, but May looked pretty solid from what we've seen in the daily data. We'll see what it means.
Don't want to get JP Morgan jealous. Chase has got tons of data, lots on balances. What do you see happening with the consumer?
Well, we do see the consumer continuing to spend, and I think when I think about what drives that, ultimately it's income growth. So again, it all ties back to this labor market report. We do see consumer sentiment is soft. We do see from consumers that they're trading down, that they're a little bit more conservative. We see delinquency rates are rising for lower income consumers. So there are cracks forming, but ultimately, as long as you're employed, you can continue to keep spending. And that is ultimately what we're seeing.
How much do you see immigration and sort of the supply shock from that level kind of changing the numbers or making it look better than it is on the labor front? That's what Steve Englander was saying earlier.
I think that is part of the story. The Fed has acknowledged that's part of the story. It's part of the painless rebalancing in the labor market that we just discussed. And it's something that we're going to have to continue to monitor. But I think probably, the bulk of that impulse, the surprise associated with immigration and the resiliency of the labor market associated with immigration, we've now factored that in. So, I'm not sure exactly how much more we're going to get from that going forward, particularly when, the whole regime could change in November.
This raises this question of what is normal. I mean, on a lot of levels, and I mean that sort of in an existential way too, but also this idea of what are we going back to? Aditya, do you have a sense of that?
So the challenge with doing that is that any of these macro models that you run to kind of get trend growth, R-star, they all tend to be a bit backward looking. So you're not going to capture structural changes until it's too late. Instead, I think you have to think about, what factors might have driven structural changes and then just make sort of qualitative judgments on how long they can last. So on the fiscal impulse, on the labor supply shock, we think that's probably not going to last because with labor force participation, ultimately demographics will win. With immigration, even if you maintain current levels, it's difficult to keep growing at these rates. So the labor supply shock has probably run its course. It could last for another 6 months as these new entrants, take time to get jobs. And then on the investment side as well, the impulse has probably run its course. So at least in growth terms, we probably go back to roughly 2% growth.
The data this week setting the stage for the Federal Reserve next Wednesday. Let's talk about that briefly. Three-part act, statement, forecast, news conference. Walk us through where we are in the dot plot at the moment, how you and the team, Kelsey, expect that to sort of evolve in the next week or so.
So the market always moves ahead of the Fed. And just to go back to this conversation on the neutral rate, we can all hypothesize what the neutral rate will be, but what are the markets saying? The markets are saying the neutral rate is higher. I don't know if it's as high as the trough that is currently being priced. The terminal rate right now is around 3.75, 4% is what the market's pricing. I think it may not be that high because that would imply a 2 or 2.5% real rate. But that being said, the market is sending you a signal, and I think we do need to listen to that. Similarly, when we think about the Fed next week and the dot plot, the market has adjusted to anticipate a dot plot that is going to show less cuts this year. And so, my expectation would be that you show, instead of 3 cuts, it's going to show 2. I don't think it could go to 1, but it could. And then I think we are on a journey for the long run dot to continue to move higher. So we saw that first move from 2.5 to 2.6. And to be honest, it's actually been going on for a while now. So if you look at the minimum and the maximum submissions, those had been drifting for really a year before the long-term dot actually started to move. So we're in a transition there. But that happens way after the market sniffs it out.
You're looking for a couple of cuts this year. You're looking for one. Do you see the Federal Reserve coming down to your view of the world next Wednesday?
It's going to be a close call between 2 and 1 cut in the dot plot this year. The question is, on the one hand, do you want to take that optionality out for September, or do you want to leave it in? And on the other hand, are you concerned about sounding too dovish and kind of moving incrementally, knowing that you'll have to move again? Right? So it'll be a close call between 2 and 1, but I think more importantly, there's going to be a lot of focus on the dots, but they're not going to matter that much because the Fed is so data dependent, right? So it's all about the data. The dots will potentially cause some knee-jerk reaction in the markets, but ultimately we just don't think they matter.
Vulnerable from one data point to the next, and you can tell us if that data point actually matters when we catch up next time. Kelsey Berro with JP Morgan. Kelsey, thank you. Bank of America's Aditya Bhave. Aditya, thank you as well, sir. Counting you down to the opening bell, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Skydance plans to offer $23 a share to investors in Paramount's voting stock as part of its plan to merge with the film and TV giant. That's according to sources familiar with the talks. The bid would be made to investors outside the Redstone family, which holds most of the voting stock. Paramount Chair Sherry Redstone is expected to speak later today at the company's annual meeting. Pressure is building on BHP and Chief Executive Mike Henry after its latest bid to acquire Anglo American failed to materialize. According to people familiar, BHP won't rush into another offer after arguing its latest bid showed restraint. The potential deal has major implications for the mining sector, with investors wary of a copper buying spree from the world's leading miner. Anglo American opted to focus on its own turnaround plan instead of taking the deal, making the next few months critical. And Intel's Pat Gelsinger is firing back at NVIDIA's Jensen Huang, who claimed that traditional processors like Intel's are running out of steam. Gelsinger saying, quote, unlike what Jensen would have you believe, Moore's Law is alive and well. We see this as the fuel that's driving the semiconductor industry to reach $1 trillion by the end of the decade. Intel has fallen behind rivals with revenue slipping in recent years. Gelsinger was brought back to the company 3 years ago to help turn things around. That's your Bloomberg Brief. John?
Yeah, thank you. Thanks for this morning. I think to really help that stock, Pat needs to stop talking about Jensen and Jensen needs to start talking about Pat. Wouldn't that change the story?
Sure.
Because
Good
when
luck
Jensen
with that.
starts talking about your name, that's more helpful.
Yeah, if you're just saying, we're coming for you, good luck with that.
Yeah, I'm not sure that works, although the stock is up in early trading. Up next on the programme, we'll set you up for the day ahead. We'll go back to Canada and look ahead to Friday. From New York City, the opening bell, about 40 minutes away. Live from New York, welcome to the programme. About 40 minutes away from the opening bell, with equities down about a third of 1%, recovering just a little bit. Here's the trading diary for this week. At 10 a.m, we'll get JOLTS data plus factory orders and durable goods at 2:30. Treasury Secretary Janet Yellen testifying on Biden's budget proposal tomorrow. ADP jobs data plus the ISM services read on Thursday. ECB rate decision, looking for that rate cut, plus jobless claims. And Friday, it's the main event. US payrolls report just around the corner. We are very, very sensitive. In fact, we are hypersensitive to incoming information in this bond market. It doesn't take much to spook people. Krishna Memani of Lafayette College joined us a little bit earlier today.
The interesting thing about the bond market is we can worry as much as we want about fiscal profligacy and all of that stuff. But the moment you see a sign of a recession arriving, that's it. For that to happen, I think consumption has to slow down significantly more, and employment has to, the growth has to taper off, and you have to start losing jobs. There's no sign of that just yet.
No big sign of that just yet, but it didn't take much of a sign yesterday to spark a rally, did it, in this bond market?
And pretty much Aditya and Kelsey both sat here and said that's not data that you can really rely on in any capacity. It's been negative for quite a while. That's peripheral data. The jobs market's going to be that much more important, and it does sort of raise the ante, not just for what we get on Friday, but 10 a.m. today, the quits number for the JOLTS data. If you have that many fewer people who are quitting their jobs, who are feeling the freedom of voluntarily exiting, does that give people sort of an additional scare? Either way, valuations being as high as they are, I think, have people more sensitive to any incoming weakness.
This is survey data versus hard data, soft versus hard, and that's the distinction that Kelsey Berro was making just 10 minutes ago. The point she made about the ISM manufacturing is for the best part of 18 months, a year and a half, that number's been negative, hasn't been great. The hard data elsewhere, look at jobs every single month, absolutely solid. So here we are talking about the prospect of rolling over, and the estimate for Friday is 185. It's 185. And the people who think that the Fed's going to cut rates in July, Andrew Holmhorst of Citi, he's looking for 140. Is 140 that bad a jobs print in the grand scheme of things?
Some people think that it's Goldilocks. I mean, if you look at Bank of America, 125 to 175 is Goldilocks. Going back, though, to manufacturing, there was a time when people thought that maybe it was reaccelerating up to services and that would generate the next wave of inflation and strengthen the economy. If that wasn't coming to pass, there could be an understandable kind of diffusing of some of that enthusiasm.
Because reacceleration was also a fear. Let's go back 2 weeks. S&P Global PMI picks up, breaks out, and people are starting to worry about reacceleration and a Federal Reserve maybe considering hiking interest rates.
If you have a Federal Reserve that is this data dependent, that doesn't seem to have any framework, well, guess what? The market's also going to be incredibly data dependent. And it's going to be swinging around. This raises a question about fragility. It raises a question about liquidity. A lot of people feel a lot of angst. Why should anyone be having conviction? How many people are actually trading in this kind of capacity? Look, we're going to look back at this time as a historically fascinating time. While we're in it, it feels rather soupy.
The lack of a strategy. Mohamed El-Erian has talked about that repeatedly on this programme. He'll be with us on Friday to break down that jobs report. And I imagine he's got some things to say as well going into next week with that Federal Reserve decision just around the corner. Before we get to Friday, much more to talk about through this week. Lots of data, lots of reaction to it. Emily Rowland and John Hancock's going to join us. We'll catch up with the former Barclays CEO, Bob Diamond. Looking forward to that. The former Federal Reserve Vice Chair, Richard Clarida. We'll talk about that lack of strategy. He'll have plenty to say. And we'll speak to Marilyn Watson of BlackRock on this bond market. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. Novak Djokovic reminded the tennis world why he's the greatest of all time as he came through another 5-set thriller to reach the quarterfinals. The world number one had to overcome a knee injury and Francisco Cerundolo to move on, closing it out 6-3 in the decider after more than 4.5 hours on court.